All right, hello everyone. Thanks for joining us. We had about 125 folks that registered. We're still waiting for some more attendees to pop in the room. So give us just a few minutes. We'll wait for some more folks to join us, and then we'll kick it off here in maybe 2 or 3 minutes. All right, thanks. All right, we still have some people trickling in, but let's go ahead and get started. I'm going to pass it off to Brian, the director of the Florida SBDC at FIU, to give a brief introduction and welcome. Brian, let me make sure you're unmuted. Can you hear us? Brian,
Okay.
you there?
Yeah, I think that did the trick. That did the trick. So I just thank you, Gray, for that introduction. I want to thank all of our attendees for being here. As you mentioned, we had about 120 people register. So I'm seeing maybe about 30 so far. So I know that a lot of folks are going to be streaming in as we kind of get the webinar going. But this particular webinar is focused on Opportunity Zone program, which is a federal incentive program, an investment program. And I just want to thank all of our sponsors and partners on this, including Madison Street Strategies. I want to thank all of the speakers that are going to talk, particularly the Small Business Administration, Palmetto Bay, the South Dade Economic Development Council, the City of Marathon, and also just of our partners, the South Dade Chamber of Commerce, Accelerate South Dade. We actually have a lot more that we can mention. So I just want to thank everybody for helping us promote it and organizing it. We do have this Opportunity Zone program that's a federal program. There's about 427 Opportunity Zones in Florida. A number of those are in Miami-Dade County and Monroe County. For our center, we did want to focus on kind of highlighting some of these Opportunity Zones that are located in South Miami-Dade and also in the Keys, particularly around Marathon. And so we wanted to discuss the program as Gray and the great presenters that he brought are going to do, but we also wanted to have some of the local presenters, the municipalities, the economic development groups, to discuss their individual opportunity zones. So this is going to be a really great program. There's going to be a lot of information for businesses, for potential investors, for folks just looking kind of to learn more about the program. And so with that, as Gray has the slide up, this Florida Small Business Development Center program, we're funded through a cooperative agreement with the SBA, the Small Business Administration. So we are an SBA resource partner. You can go to the next slide. And we are part of the Florida SBDC network. So I know nowadays with webinars, we hope that you guys are in South Miami-Dade or Miami-Dade County or Monroe, but we know webinars, you could be anywhere in the state of Florida or anywhere in the country. We do hope there's a couple of investors from out of Florida. Maybe you guys can get in touch with some of the municipalities on some projects in their areas. But if you're a business owner in Florida and you're not located in Miami-Dade or Monroe County, don't worry, because as you can see from the map, we have a local SBDC near you. You know, Mark Twain always said, if you enjoy your job, you're never going to work a day in your life. We have a really great job that we're here to help you start and grow your businesses. And the best part is because we're an SBA resource partner, we do that at no cost to you. So it's no cost to you, and we're focused on business strategy, access to capital. You can go to the next slide. This kind of shows you the services that we offer. It's done one-on-one. Obviously, right now, we're all doing virtual and phone consultations, and then also providing, you know, webinars such as this. But we can help you start your business. We can help you with access to capital. If you need more disaster funding, if you need more traditional funding, we can help you with financial management, international trade, marketing and growth, government contracting. A lot of businesses have needed help recently on HR, operations, strategy. One of the other things we can do is give you access to really good market research, data, information to help you make informed decisions about your business, whether that's kind of local, you know, information, customer information, industry data, things like that. And then we do have some specialized services and programs that we do offer. You can go to the next slide. And this is the next two slides are my two favorite slides. This is actually my team that does all the hard work. So as you can see, we have a really great team that's located in Miami-Dade County that is here to help you out. And we actually did receive some additional funding from the Small Business Administration from the CARES Act to provide some additional services. In a normal year, you know, no hurricanes, no pandemics, we work with about 1,000 clients a year. As I live and breathe right now, we've assisted almost 1,900 clients. We've seen probably about 1,600 since March 1st. And so we've really been hustling to help you guys to get all these, you know, loans, disaster loans, PPP, you know, all those. But a lot of other businesses have been focused on kind of growth capital, strategies, operations, you know, pivoting, marketing. So we have a really great team in Miami that can help you with those services. But if you're not in Miami, if you're in Monroe County, you can go to the next slide. We actually have additional consultants in the Keys as well. So we have a really great local team of business consultants located in the Keys that are focused on helping to grow businesses in Miami-Dade County. And we actually recently added one additional consultant that she's not yet on the flyer, but we're hoping to add her on this slide for the next presentation. So I just want to say, if we can help you in any way, I'm going to put our contact information and our website in the chat. You know, feel free to reach out to us, and definitely we can also help you in terms of opportunity zones, in terms of getting more information on the program, you know, getting connected with folks to help you kind of look into the resources. So definitely feel free to reach out to us or some of the presenters that are on here if we can help you in any way. And just thanks again to Gray and Madison Street for helping to organize and facilitate this. And thank you to all of our really great presenters that you're going to hear from today. And with that, I'll shut up because you didn't log in to hear me. You want to hear from all the presenters. So thanks again.
All right. Thanks so much, Brian, for that introduction. Always great to see the work highlighted that y'all do down at the SBDC at FIU. As he mentioned, y'all reach out with any questions. And you should all have my contact info from sending out reminders for this webinar. If you need to get in touch with Brian or any of their team, I'm happy to introduce you directly, or you can go to their website. So let's kick things off. As Brian mentioned, this is a partnership for these webinars. My company's Madison Street Strategies will get a little bit more of a formal introduction in a little bit, but I'm thrilled to partner with the SBDC across the state. We're doing these webinars in each of the 9 regions. So this is the 5th webinar. We're at the halfway point. I'm very excited about it. So that's me, Gray Dodge. I'm the founder of Madison Street Strategies, an economic development consultant. Spent the last few years in state government and economic development before launching my firm, Madison Street Strategies. So logistics for the webinar. Everyone is muted, all the participants, but you can ask questions in your control panel on your screen. You should see a questions tab. You can enter your question there. Me and my team will see those and be able to ask those of whoever's presenting, or if it's for someone that's previously presented and is not on the webinar anymore, we can forward that question to them later on and get you in touch. So feel free to send any of your questions there. It does look like we already have a question. Will the presentation and the recording be sent to the attendees? And we are just about to get there. So the presentation will be available. There's already a handout now. You can see on your control panel near the bottom, there's a handouts tab. If you click on that, there is a PDF document that's called Master SBDC FIU OZ Slides. Very fun title. So that is all of the presentations you're going to see today, all of the slide decks. That's everything in one large file. It is about 50 megabytes, so have fun downloading it, but it is a lot of content, so feel free to reference that at any point. The webinar is also being recorded. It's being recorded currently, and it will be available to everyone that registered and that attended after the event is over. So the SBDC, Brian and his team will send out a follow-up over the next few days with a link to the recording and with a link to the slides in case anybody didn't get a chance to download those. But since the link is there already in your handout section, you may as well go ahead and download it now and have it saved. We'll try and work in breaks if we can. We got a packed agenda, so we'll see if we can. But again, this is being recorded. If you have to step away for a second, or you have a call or a meeting you got to run to, totally understand, and hopefully you can catch the recording afterwards. So the agenda for today, the welcome's already happened. The webinar logistics, we're running a couple minutes behind on, which is fine. It's just cutting into my presentation, so I can make that brief. And that's really just starting high level, the opportunity zones in Florida. How did we get here today? Then we're going to, at 1:30, segue to opportunity fund creation and investment. Excited about that presentation from David Brim. He's been a good partner for all of these webinars. He is bivocational here. He's a chief strategy officer at Bright Impact, but he's also one of the founding partners of the Orlando Opportunity Fund. So he's going to talk about some of his experience creating the fund, what that fund is looking for, types of businesses and real estate that they're looking for. Then Paul St. Pierre, a founder of PSP Advisors out of Orlando. He'll be presenting from 1:50 to 2:10 on using OZ Capital for your small business, some tips and tricks there. Then we're going to get into some of the legal regulations from Tucker Toney, an associate tax attorney at Gray Robinson. He's based out of their Orlando office. OZ Accounting and COVID-19 Relief, Stephen and Carol from Eisner Amper. They're both partners there. Eisner Amper, a large accounting firm. They are in the South Florida office. So they'll be presenting on some of the accounting regulations and also some CARES Act, some of the COVID-19 relief, some of the programs that are currently out, which they'll discuss briefly, but as Brian mentioned, they've gotten some funding to help businesses with some of that. So reach out to him and his team as well if you need more clarification or need to work through some of that CARES Act funding. 3 o'clock, we have the US SBA. This is really kind of a directive from the SBA that launched these webinars. So excited about that presentation. Althea Harris from the South Florida District Office will be on to present about some of the SBA resources and what they're doing for maximizing impact in opportunity zones. Then we have some local presentations, starting off with opportunities in South Dade, Mr. Peter England, the Executive Director of the South Dade Economic Development Council. Then opportunities in Palmetto Bay with Maria Pineda, the Community and Economic Development Director, the Village of Palmetto Bay. And then opportunities in Marathon with George Garrett, the Planning Director for the City of Marathon. So each one of those are presentations. They're going to cover some of their local zones, some of the activity that's going on, what makes those zones interesting to either start your business or do some opportunity zone investing. So we're going to launch a couple polls real quick, try and get to know our attendees since we don't get a chance to hear from you as much. So the first poll is launching now. That says, who are our attendees? So select one of those, either a small business owner or a worker in a small business, maybe a partner or leadership, management, something like that. The next one is government, either a local, state, or federal government. We get a lot of government partners on this, either economic development organizations, community development organizations, et cetera. And then potential investors, anybody that's interested in investing into a business or into real estate that's in an opportunity zone, check that box. And if you don't fit any of those categories, the last box is for you, the other category. And that's really just folks that maybe heard about the webinar, saw the free event, wanted to attend and learn a little bit more about this program. So yeah, please go ahead and fill that out. Looks like we've gotten some good responses already. I'll let it run another second, let a couple more votes come in. Okay, that's a good stopping point. So good turnout. We have 75% of you, 76% of you now saying small business owner / worker. 3% are government, local, state, and federal. That means our presenters have not joined us yet, but they'll be on later. 5% are potential investors, and 16% are other. That's our highest other category of any of these webinars so far. All right, let's close that one. We do have one more poll we're going to launch. How familiar are you with opportunity zones? This is good, so we get some background on our attendees. Number one, I'm practically an expert. So our speakers on the line, feel free to check that box. Number two, I've read some background and attended some workshops. There have been a lot of opportunity zone conferences and workshops in the Miami area. So I wouldn't be surprised if some of you folks have attended some of those. I've attended some of those. I've spoken at some and hosted some before. I'm vaguely familiar. Or the last box, what are opportunity zones? And be honest, we get lots of answers for that one. Which, if you're asking that question, you've come to the right place. Okay, 0%, I'm practically an expert. 26%, I've read some background and attended some workshops. 51% are vaguely familiar with opportunity zones. And 23% say, what are opportunity zones? All right, that's a quarter of you, good. We will hopefully answer that question today and make some sense out of all this. All right, so let's get started. Running a little bit late now, but I will keep this brief. So I'm just going to go over the high level, what are opportunity zones, how did we get here today? Number one, my firm, Madison Street Strategies, we're an economic development consulting firm, mostly focused on opportunity zones, some development finance, affordable housing. Opportunity zone creation, these were created December 2017 in the Tax Cuts and Jobs Act. There's 8,700 zones nationwide, and in Florida, there's 427 opportunity zones, and we got there from 1,706 eligible low-income census tracts. So what the heck does that mean? So the basis for creating opportunity zones, these all had to be low-income census tracts. So some people, we get a lot of questions of, well, why isn't this chosen as an opportunity zone, or why wasn't this chosen? And the starting point to answer that is always, was it even eligible? Not just any census tract could be chosen. They had to be low income, which is designated by HUD and the US Census Bureau. So that was the starting point. From there, the federal legislation, it gave authority to the governor of every state to nominate 25% of those low income census tracts as opportunity zones. So the other question, if you're asking, why wasn't this zone selected? It is a low income census tract. Well, then this answers that question, because we could only choose 25% of them, which I'll talk about in just a second, what that process was like. The whole policy here, the idea is to encourage long-term investment in low-income communities. Long-term investments in low-income communities. So very high level, again, reinvesting unrealized capital gains into opportunity funds provides tax incentives to the investor. And for our small businesses on the line, or maybe our property owners on the line, how do you benefit from this? You benefit by access to capital. That's what this is doing. You have a way to raise funds and say, hey, yes, I'm an opportunity zone business or I'm an opportunity zone property, more of which we will talk about. Again, very high level, capital gains dollars have to go into an opportunity fund. That is a requirement, which we'll talk about. The funds then can invest in opportunity zone property or opportunity zone businesses. You'll hear people say qualified opportunity zone businesses or qualified opportunity zone property. But that fund investing in that property or the business, you get tax benefits to the actual investors in that fund. What are those tax benefits? This is the most exciting part. Number one is a tax deferral. So any capital gains that are invested into an opportunity fund today, you don't pay taxes on until December 31st, 2026. Or if you realize, if you sell that investment before then you realize it then. But if you keep it in the fund, December 31st, 2026. The second is a step up in basis. We still have the opportunity for the 5-year. We've lost the opportunity for the 7-year since we're a couple years into the program now. But you can still get a 10% step up in basis if you invest now and hold it in there for at least 5 years before that 2026. So that's a 10% step up in basis. So as easy as possible, you invest $1 million in capital gains dollars. That million, if you hold it for 5 years, now you're liable for taxes on $900,000. That's your 10% step up. Very simple and high level. We'll get into more details on that, but let's make sure everybody's on the same page first. And then number 3 is the most exciting tax benefit. That's a permanent exclusion. So any investments held for 10 years in the opportunity fund will pay no capital gains tax on the post-acquisition gains. So what do I mean? So you invest $1 million in that fund. The fund in 10 years is now worth $2 million. That extra $1 million in post-acquisition capital gains, you pay no capital gains taxes on that $1 million. So your $2 million that's worth 10 years from now, your tax liability is on $900,000 because you've gotten that step up in basis after 5 years, and now after 10 years, you get that benefit. So you can sell at 10 years and still realize that benefit, or you can keep the investment going. The program's recognized until 2047 in current IRS regs. Opportunity funds, I mentioned earlier, these are a legal entity, and Tucker will talk a little bit more about what that means, but it can be as simple as an LLC or a corporation. You or I or anyone that's watching now can start their own opportunity fund if they'd like to. So that's really all that's required. Anybody can go file one with the state right now and have their own opportunity fund. No requirements on fund size or scope. That's very important. So what we're seeing is varying opportunity funds across the country. We're seeing some $2 billion funds. We're seeing some $500,000 funds. We're seeing funds like the Orlando Opportunity Fund based in Central Florida that really care about Florida, that want to invest locally, that want to make a difference locally. And then you have some funds that are just interested in investing anywhere across the country, anywhere in any of those zones. There's no requirement on where they can invest. And the scope too, these funds can invest in businesses, they can invest in property, they can invest in both, they can invest in one or the other. And some of them are specialty, some of them are just interested in property. A lot of funds are interested in commercial real estate, although that is a little iffy in COVID times, but there's no requirement there. So it really just depends how you organize the fund and what you want your investment priorities to be. And it has to be an equity investment. That is in red there because this is not debt financing. This is an equity investment. So for my business owners, if you're taking on a opportunity zone investor into your business, that's equity investment. They're coming in more or less as a partner. They're going to have some say. You're not just borrowing money and paying it back. They're investing in your growth. So that's an important thing to think about if you're considering bringing on investors. Florida's nomination process, I'm going to try and breeze through this, but at least one in every county. That was a state decision. So every county in the state of Florida has at least one zone. From there, they were proportionally allocated. So our rural counties may have one zone, while Miami-Dade County has 67. Then an economic analysis of poverty, unemployment, and population. So in Miami-Dade, there's 67 zones, but there were hundreds that were eligible. So from there, how did we decide the 67 that got chosen? Well, it was an economic analysis. So I was the policy director at the Florida Department of Economic Opportunity when this program was announced, and Governor Scott asked our office to really take the lead on doing this data analysis and working with communities to figure out which zone should be nominated so that the governor could submit that nomination. So we were involved in all of this process. And then the last step that we took was a big one. It was getting input from those local governments, investors, businesses, elected officials, developers, et cetera. Really, we trusted them as the boots on the ground for economic development. So if there was a zone that they wanted to prioritize because they had a lot of public investment going in, or they knew of some private investment going on and they thought that was the best zone to choose, then we listened to them 9 times out of 10. As long as it was an eligible zone, the data told the story, and we could choose that. So that led us to where we are today: 427 zones in Florida, 1.9 million residents in those zones, 1 million jobs in those zones, and 83,000 businesses in those zones. This slide just kind of tells the picture of where we're at, why are opportunity zones important from a policy perspective. That top bar is Florida state averages. The bottom bar there is our opportunity zone averages. So a couple things to highlight, like the poverty rate. If we're at a 16% poverty rate in Florida, our zones average a 31% poverty rate. A median income in zones is nearly half the state average at 31,000 compared to the state average of 52. The number of folks with bachelor's degrees or higher is half of the state average. So you can see that there's really a telling story for these low-income census tracts, these low-income communities, to get nominated and try and take on some capital. That's why it was able to get some bipartisan support. It's just showing some of the cities with the largest number of zones. I believe the city of Miami alone has 28 tracts, and the county has 67. So as I mentioned earlier, the funds are mostly interested in commercial real estate. Now, this is tough to tell because this is all voluntary data at this point. There's no required reporting for funds, what they're investing in, what they're looking for. So this was a voluntary poll that some funds responded to, and the majority of the funds, as you can see there, were invested in commercial real estate. But community development, economic development, infrastructure also got some votes from other funds. What's happening at the federal level? As I've mentioned, we've gotten some guidance. That's what our accountants and attorneys will dig into in a little bit. The White House Opportunity and Revitalization Council, that was created by White House Executive Order. It's 13 federal agencies, grant-making agencies, that have come together to figure out how to maximize investment in opportunity zones. Not necessarily by creating new programs, but by using existing programs, existing grant dollars. How do we funnel those better into opportunity zone projects? So we've seen a lot of good announcements come from that group already. It's chaired by Secretary Ben Carson, the executive director Scott Turner. HUD has created a website, opportunityzones.gov. They have some good resources on there. They have a map of all the opportunity zones. This report, there's a little screenshot to the right on this slide. The impact of opportunity zones, an initial assessment, shows really good data. It's very clear that this is working so far. There's been a huge uptick in the number of investment and the amount of investment in these opportunity zones across the country compared to before the program was announced. So go to that website, look around a little bit, you'll see some good resources. We're advocating for different things at the state level, like state grant programs or layering OZ data with other state data. Maybe you want to see if it's in a historic preservation district, et cetera. The community role is really the most important. We're advocating for cities and villages and counties to create opportunity zone prospectuses, economic development organizations, to create an opportunity zone prospectus. This is kind of the industry leading tool for opportunity zones. The screenshot here is for the prospectus that the organization Invest Atlanta put together for the city of Atlanta back in March 2019. So they were out of the gate pretty early. They have a Invest Atlanta has a chief opportunity zone officer up there. So they have a lot of support for opportunity zones, which is great. In that prospectus, you're identifying some of the data, some of the assets, identifying projects, and identifying businesses. So that's a great tool for communities to use. Review zoning and permitting. That's very important in those zones. Look at how you can further incentivize investment or startups to move there and grow. Are these just zoned agricultural, or are they industrial? Are they zoned multifamily? You want to attract some multifamily development. Communities can really incentivize investors and developers by taking care of some of that early, so that property purchaser doesn't have to take it through those processes. Publicly owned property, that's certainly interesting. I'm going to breeze through this. Opportunity zones for businesses. As I mentioned, equity investments in businesses is allowed. There are some opportunities, some investment funds that have already launched that are looking for this, including Orlando Opportunity Fund. You're about to hear from them here in just a minute. As soon as I shut up, David Brim will be presenting. And then some other funds that are listed there too. Again, these slides are available as a handout, so feel free if you want to look into any of those funds and try and find out more of what they're looking for, reach out to them. Some operating businesses, this is just random, not an advertisement, but it's just some businesses that have made news for actively seeking opportunity zone investors and partners. Businesses that have said, hey, we're in a growth stage. This is an article that came out about a co-working company in Colorado called Proximity. And they create hardware and software solutions for co-working spaces. And they were able to nab some opportunity zone investment to help them grow into more cities in Colorado. So there are requirements that your business has to meet, but our attorneys and CPAs can talk about some of those. Mission, place, and timing matters. Make sure you're meeting up and getting the right investor for your deal. As I mentioned, this is equity, this is not debt. You're not just taking out a loan, you're bringing in somebody that's likely gonna have some say in your company and your operations. That's my contact info there. Sorry, I'm out of breath. I was trying to speed through that. We've condensed it for today, but feel free to give us a call, shoot us an email, or visit our website. Would be happy to talk more. And with that, I'm going to turn it over. David Brim is the Chief Strategy Officer for Bright Impact Capital and the partner at the Orlando Opportunity Fund. And he's going to talk about Opportunity Fund creation in his presentation, Maximizing Your Window of Opportunity. David, welcome. Good morning, or good afternoon.
Thanks, Greg. Good afternoon.
Hey.
Hi, everyone. I'm going to get right in and hop in. So, Greg, you can go to the next slide, please. So earlier this year, the Small Business Trends Alliance surveyed 3,000 business owners, and the top challenge that they came up with was the lack of capital and cash flow. This has magnified even more significantly with the pandemic progressing and everything like that. I think this survey was actually done in January or February pre-pandemic, so it's gotten even worse. So what would these small business owners use this funding for? 29% said expansion, 16% said inventory, equipment purchases, and 39% said for working capital. So when you look at this need, and then we go to the next slide, you can kind of see here, next slide, please, the impact, potential impact. Oops, sorry, Gray, previous slide. The impact potentially of this program. So investors lining up to pour billions of dollars into opportunity zones, $500 million fund to invest in opportunity zone possibilities, $6 trillion opportunity. So these are really big numbers. And a lot of times entrepreneurs will see this and really get googly eyed, and there is potential here. So it's something to be aware of. Not every business may benefit from this. You might not be set up properly in terms of the type of business that could attract investors, but we're going to talk a little bit more about that. It's definitely something you should pay attention to. Next slide, please. So a little bit about me. My name is David Brim. I am a co-founder of Orlando Opportunity Fund and also Bright Impact. My background is really in marketing as well as entrepreneurship in terms of software. I've started a couple different software as a service companies, some online directories. I've taken some profits from that and invested into real estate, so I got exposed to that. And I really began kind of shifting more into the investor role. And I was really focused on helping to champion entrepreneurship and create more funding opportunities for startups in Orlando. Historically, in Central Florida, there hasn't really been much investment in the startup community. A lot of the investment goes to real estate, private lending, and kind of more traditional investments like the stock market. And I was trying to figure out a way to incentivize investors to invest in startups. And this was before opportunity zones came into existence. And I approached Orange County and I said, is there a way for investors who have rental properties to invest in startups and then get some sort of break on their taxes if they can prove they've invested in a startup? And they said, really interesting idea, but we rely on that income from tax dollars to really support our operations for the county. And that's not really something that we could do. And then right when all this was happening, then opportunity zones really came all about in late 2017 and really took effect into 2018. So I really went all in on this. And just a little bit of a backstory, my initial desire was to create Orlando Opportunity Fund. We'll get into that momentarily. And then actually, yeah, let's go to the next slide, please. So Orlando Opportunity Fund was my initial goal, and I had the focus of how do we unlock this wealth that's in our community that's investing in real estate and funnel it more towards startups. And so we came up with the idea, actually it was my initial idea, and then I kind of sought out to build the team. I approached Donna McKenzie, who is to my right, and she was at the time the executive director of Starter Studio, which is a leading tech accelerator in Orlando. She's also a CPA by trade and has been a CFO of a company that grew and got acquired by Google. And I told her about this and she hadn't heard about it. And when she did her research, she said, my God, this could be amazing. And so we further built the team out. John Cooper on the far left is our president of startup investments. John has been a partner at Houlihan Lokey, which is the largest M&A firm in the country by volume. And he's done probably 600 plus tech sector acquisitions. He understands how companies are kind of prepared to be sold, the process of acquiring a company. He knows a lot of the players on the West Coast. And so he's also an active angel investor. And so he came on board as our president of startups. Vince Wally is on the far right. He's a very successful real estate investor and one of the leading commercial real estate brokers in Central Florida. And he came on as our president of real estate. What we kind of did here was we created a structure that invests in both commercial real estate and startups. So it's a blended fund. It's a target of a $20 million raise. We have made 2 investments to date, and actually just today have confirmed that we're making a 3rd investment. And I can talk a little bit about the types of companies a little bit later, but let's progress to the next slide, please. So Bright Impact really came about because we had a lot of ambiguity about the regulations, as did many others. It was really clear how a real estate investment was to work in opportunity zones. It wasn't as clear for business investments. And so our big part of our thesis was investing in startups. And so we had to sit on our hands for a while until the regulations became more clear. And during that time, we had already immersed ourselves in the opportunity zone space. We started having lots of individual investors that wanted to create their own opportunity funds. And so we stood up a consulting group and fund administration business called Bright Impact, and really helped others get started, understand the compliance requirements, and really handle fund administration for them. And during that process, we also uncovered a need to create a software. And so we are pretty much in the final stages of launching our software, which is like an opportunity zone management in a box type solution. And you can manage investments, manage investors, compliance, track the impact, and also dig into opportunity zones around the country and understand the makeup, jobs, economic data, et cetera, owners versus renters. We also have a community portal that we've created. So if communities want to showcase their opportunity zone projects, they can. Next slide, please. Okay, I'm going to breeze through this pretty quickly because I thought Gray did a phenomenal job really outlining opportunity zones for you all at the introductory level. So next slide, please. So it took into effect really at the beginning of 2018, got enacted into legislation 22nd, 2017. Next slide, please. A lot of this, so I want to reiterate some of the points that that Gray made, because there's really three main benefits. An investor who's had a capital gain, sold real estate, stock, a business, really anything, artwork, cattle, can invest into a fund, and they can defer their taxation until the end of 2026. They also, on this next point, it says there's a 10 to 15% step up in basis, but if they hold their investment for 5 years, they get a 10% step up, basically reduction of their taxation. The 5% actually expired, and so that's no longer available. The major benefit here is really tax-free appreciation on a 10-year hold. So again, investor invests $1 million into a fund, and that fund maybe invest in some startups and hit some unicorns that have huge exits. That $1 million might be worth, you know, $5 or $8 million, and they get that gain tax-free after 10 years, which is pretty amazing. Next slide, please. So the ability for opportunity zones to really transform communities is also there. So creation of jobs, business growth, increased revenue, and kind of operational budgets for some of these communities, higher average wages, appreciation of really property, and several other really qualitative and quantitative impact for the communities. Next slide. So they exist, opportunity zones exist all across the country, also in US territories like Puerto Rico and Guam, and some other areas as well. And so there's, I know we're focused on Florida, so we'll breeze past this as well. Next slide, please. So eligible investments to the fund, real estate, operating businesses, public-private partnerships, even infrastructure type projects can be done. You cannot invest in sin businesses, and so liquor stores, massage parlors, golf courses, country clubs, bars, those are all excluded. Now there is a carve out where if you have like a small percent, I'm not sure the exact percentage, but if you're a hotel, for instance, that's received investment, and you have a small section of it that's kind of a you know, spa or something like that, then that could be acceptable depending on the percentage of revenue it generates. Next slide, please. So a lot of this compliance, some of the other presenters are going to dig into it a lot more, and frankly, they're more qualified to speak about it, being CPAs and also attorneys, than I am. But these are just some highlights. Of course, the entity has to be a corporation or partnership that's getting the investment. It has to be headquartered in an opportunity zone, or plans to move into one extremely shortly after the investment. And again, some of the other presenters can elaborate on that. There are some different asset tests that are required for both the fund and also the business. There's also a gross income test and series of aspects to consider. So before, they said that 50% of gross income had to be from active conduct within the zone. And for us, we had a lot of, we didn't fully understand how that was being interpreted, because if you have a startup that's selling across the world, not all of it is necessarily active conduct within the zone. Well, is it based on like where your coders are, or is it based on where the application is hosted, or the servers are? And so we had to get some clarity on that. And now it's basically understood that if you're hiring contractors or employees, a certain amount of hours or dollars spent have to be allocated to workers within a zone. And then there's some other aspects here to consider. So let's proceed to the next slide, please. So there's many funding options to grow a business, and there's some that are depicted on this slide here. So of course, if you are in a position where you could fund through customer revenue, that's, in my opinion, one of the best ways to do it. Historically, I've had some businesses where, you know, we have pre-sold things and got deposits and kind of used that to finish completing the work, and then you get another deposit or the final payment once it's completed. Those can be great ways to scale business without the need for outside capital, whether it be debt or equity. If you are, a lot of times looking to grow quickly, you're required to get capital faster, and there's some different options for that. A loan is a lot of people startups and entrepreneurs don't like the idea of loans, but the reality is if you truly believe in your business and you can execute on that loan and retain the equity, debt can be a lot cheaper than equity, and you can scale up your company and potentially have more ownership, but it is a lot more stressful, and you have the carrying cost and kind of debt burden sometimes that can hinder and kind of choke your company. And so the idea of getting friends and family money can be considered. We talked about product pre-sales and customer revenue to fund your business. Having a side business, I've done that before, in the sense that I had a software company that we were running out of money, and so I created a marketing agency and kind of did the work for other people, and then the extra capacity that we had for our team, I would allocate to my software project. There's good aspects about that, and there's bad. The bad news is you kind of get distracted, and your project is usually the last one, because paying customers kind of squeaky wheel gets the oil kind of thing, and you can get distracted. Home equity loans can be great. Sometimes you don't want to risk fully losing your house if something goes sideways, but the idea is like I've owned, or I still own, some rental properties and duplexes, and at the time when I first was starting my entrepreneurial journey, we ended up buying a duplex, lived on one side and rented the other, and our rental expenses were very, very low. If actually we were living for free. And then when we moved out, we had some equity in there. We used it to purchase another property and invest in companies. So there's ways to do that. Now, credit cards wouldn't necessarily advise that. The idea of opportunity zone capital fits really at that bottom section between angel investors and venture capitalists. It's really a subset of private equity. So let's progress to the next slide, please. So is raising opportunity zone capital right for you? So you have to ask yourself, do you have a scalable business model? Do you have something that really you can get this capital and ramp it up and kind of just really scale it? And the idea of market validation is important. So a lot of times I'll speak to entrepreneurs or business owners, and you ask them who their customer is, and they'll say, well, medical and oil and energy, and they'll start naming all these industries, and that's not a customer. A customer is really within a specific industry and really a specific job title, and getting really clear on how you're going to sell that and who you're speaking to. So really understanding who you're selling to, and also does your product really have that product market fit and fit the needs that they have? Is the market that you're selling into growing? And do you have a competitive advantage, whether it's IP or relationships that you've developed over a long career in a certain industry, or contacts you have? So we talked about some of the other funding sources. Can you fund through customer sales? Can you obtain a loan and retain your equity? And the idea of giving up control. So when you get an equity investment, you're going to have another party that's going to have responsibility of their money, and you have to understand that they may have different ideas that they could impose on you for your business. Now, some of that it can be worked out in the agreement when you're taking that money, but realize that there is some level of control that you'll have to give up oftentimes when you receive an equity investment. And of course, the idea of opportunities on specifics. I had this dialogue with the company today, really asking them if they're willing to remain in an opportunity zone for the long run, because the last thing we want to do is invest in a company and then have them move out of the zone and really blow our fund compliance and have other penalties. So those are all things that have to be understood. And then also committing to being an opportunity zone business and remaining compliant, and again, sharing information with the fund to keep them compliant. Next slide, please. So what are your opportunity zone capital options? If you want to proceed with this, there's really two routes to do it. The first is you can consider creating your own fund. I was talking to a company today that called, and they had a particular project, and they're thinking about creating their own fund to raise capital for it, and for the sole purpose of investing in their business. And you can do that. Now, the other option is raising capital from existing opportunity funds. When you create your own fund, I mean, there's a lot of, again, kind of administration and compliance that could go with it, and you're raising money, and you're not necessarily focused now on selling your customers. You're also focused on selling investors. And granted, you still have to do that if you are pitching investors from an existing fund, but it can be even more intensive sometimes if you're creating your own fund. So those are the real two options that you have here. Next slide, please. So what are business-focused opportunity funds looking for? Each fund will have their own thesis, and I talked a little bit about ours earlier. But in general, when a business-focused opportunity fund invests in a company, they really want the market growth potential. They want to understand that you have a scalable business model and can really, the idea of pouring gasoline on a fire and helping it grow a lot quicker. Probably a bad example was everything happening in California now, but the idea of they don't necessarily want to take chances. They want to run up the score, even though there's a level of risk, obviously, but they want a business that can really scale up with their capital and kind of 10x, so to speak. You want to have market validation, product market fit, some initial traction. For us, we really like seeing initial traction and having maybe some early revenue or early purchase agreements in place to kind of de-risk it a little bit from that standpoint. We don't just invest in ideas on a napkin. Competitive advantage, so how are you kind of creating moats and barriers to entry potentially? Having a clear target prospect, we talked about that. So many businesses don't really understand or have their customer prospects prioritized, and that's really important. And again, we talked about some initial traction and success. On the entrepreneur and team level, do you have the experience and contacts and skills required to win in your marketplace? If it's a technology, we often like to see a technical founder and a business kind of lead founder, and that way they have that diverse but complementary skill sets. Are you coachable? Are you resourceful? To me, that's really important for an entrepreneur to really be resourceful, and you want them to, and that's why the traction is so important initially, some initial traction, because you want to see that they can kind of stretch out the capital that they have and really make things happen and be scrappy, as compared to wasting. We don't just want to put money into a business and then use it for salaries and then have them kind of rest on their laurels, and all of a sudden you blow that money and you don't get anywhere. So we really like to see them be resourceful and scrappy, and of course being able to declare themselves as a QOZB and remain compliant. Next slide, please. So for us, we have invested in so far a medical device company and a health tech company, and likely soon here a fintech company. So those are kind of our segments. Software as a service, Internet of Things we're interested in. Those are like smart sensors. The idea of I heard of a business that you have like sensors in like a kind of a Tupperware container, and it tells you if food is spoiling or not, kind of thing. It's kind of interesting. Educational tech, fintech, we talked about. So that is our focus as a fund, at least from the startup side of things. Commercial real estate, we're interested in. We're pretty opportunistic. If it makes sense and pencils out, we'll take a look at it. Definitely like the retail opportunities, and potentially we would look at some apartment type deals too. But it's just everything right now on the real estate end has actually been on hold. We haven't found many great deals, and so if anyone has any deals and wants to send them our way, we can take a look at them. But we've actually been way more active on the startup side, just based on the current climate and what's been going on the real estate front. So next slide, please. And looks like we've reached the end. So I appreciate you all listening, and I will turn it back over to Gray.
All right, thanks so much, David. Thanks for being here as always. Great presentation. His contact info is on the screen there. So if anybody wants to reach out and ask more questions about Bright Impact or the Orlando Opportunity Fund, shoot him an email or follow his blog and get some more content there. All right, thanks again. We're going to hand it off now to Paul St. Pierre with PSP Advisors. Paul, are you there?
Here I am, Gray. Good afternoon, everybody.
Hey, Paul, go ahead and kick it off.
Yeah, we're halfway through the series. It's been going great, and we're gonna keep going all year long to hit the rest of Florida. I'm here in Central Florida. Turn to slide 2. You can see me with no hair, a little bit of white hair on the side, and in front of the non-original palm tree, non-native palm tree here in my neighborhood. I've played many positions in. I've worked for more than 40 years. I started working after graduate school in 1981. And, throughout my career, I've done most of the professional positions in real estate and private equity. I've never served as a developer. I've never built anything other than 1 or 2 of my homes, but I've spent many years in the alternative investment strategies area, which I theme together as real estate, private equity, corporate credit. I've served as a fund manager, an investment advisor, real estate securities manager, an investment banker, raising debt and equity for program equity for developers and acquirers to develop real estate and to buy student housing portfolios, et cetera, et cetera. So my contact information is up on the top there. No website, but LinkedIn and email will get to me. Next slide, please. So this is one of my mantras, I guess, today. It's a long mantra, but when I talk to people and professionals and everybody sniffing around the opportunity zone capital markets, I really strongly advise that any business or any real estate owner or to-be owners or business information, I really state that it's in your best interest to take a hard look at the Opportunity Zone program, the geography of it, where these are located, what they feel like, and to really understand the cost benefits of how the Opportunity Zone capital markets can apply to you and to your shareholders. So that even includes if you own real estate, if you bought real estate long before the Tax Act was launched this program. There's something in it for everybody, but you got to study those benefits. To do a real estate project or start a business, move a business. You're going to hear this word a lot, qualified opportunity zone business. And so really it's a question of whether you want to or should or could pursue this effort of incorporating opportunity zone capital within your capital stack. That's equity capital. So to understand the long-term benefits and what it means to have an opportunity fund investor sitting in your investor table, and the alternative pathways to find this capital. It's not necessarily a straight path. There's capital formation, but we expect the hockey stick to keep in the hockey stick formation. Next slide, please. Since this webinar started today, you've already been hit with several acronyms of OZ and Qualified Opportunity Zone Funds and QOZBs. This is just my schematic that I try to help the audience try to sort it all out in terms of, what are we talking about here? I call it the barbell. On the left side are the capital providers. Those are the U.S. taxpayers, individuals and corporations that can come to the table with their capital gains and take advantage of the tax advantages and the economic benefits that Gray and David were talking about, the deferred elements, the forgiveness of capital gains, et cetera. So money on the left side. In the purple zone here, we have the qualified opportunity funds. I call it an intermediary. It's really just like registered investment companies and REITs. It's an intermediary. It's a connecting the capital with the investments. It's a required intermediary. You can't really play in this area without an opportunity fund somewhere between the money and the investments. And then on the right side is the whole theater of investments across the 8,500, 8,600 opportunity zones, 427 here in Florida, which is a significant amount of opportunity zones and a lot of I think Gray went through the stats there in terms of how much of Florida is really represented in these opportunity zones in terms of jobs, businesses, population. So it's a meaningful target zone to focus on it. Other terminology we got in the lower right here, qualified opportunity zone property. That includes what can the fund invest in. So fundamentally, the fund can only invest in securities that are issued by the qualified opportunity zone business. So that's stock or partnership interests, and opportunity funds all. Next slide, please.
Well, I think you're cutting out a little bit, but I got you back now.
Did you lose me? Okay. The key attributes, Gray and David talked about this, but there's really, this is an area to really let your imagination run wild, or really think through a lot of imaginative ideas. The Opportunity Zone program, despite the depth of regulations, it does allow a freedom of imagination in terms of what you can do with the money. So in the business area, to invest in business, it can be used for startup capital to launch a new business. It can be used, obviously, to grow a business. So let's say a business has been in development stage.
What's up?
For the last 1 to 2 years, and it's time to ramp it up. But that may require substantial capital to create manufacturing capability or distribution capability or sales capability and marketing capacity. So there could usually be a need for equity capital to ramp up the business. Rescue capital, quite relevant for the coronavirus age, the coronavirus era. We're certainly aware of the pain that businesses have gone through, the failure of businesses going out of business. But for the survivors and the wannabe comebacks, we believe that the White House and Congress is going to continue to bestow benefits, special benefits on the Opportunity Zone program to ensure that a good proportion of capital is channeling through the Opportunity Zone program for recovery on many different fronts, recovery and stabilization. Relocation capital, it's all about getting businesses in the zone. So relocation capital can be used to move a business. So let's say there's a lumber yard. Let's say there's a bunch of lumber yards outside of opportunity zones. They might be right in the middle of very, very busy commercial areas. Maybe it's not the best place for lumber yards and agricultural supply businesses, et cetera. It may be more prudent to relocate those businesses into an opportunity zone if they need some capital to relocate or to incentivize the relocation. This could be useful money to relocate businesses where they can lower their cost points and improve their profitability. Mergers and acquisitions, obviously, that game is coming after we see some stabilization come through this coronavirus era. America loves mergers and acquisitions, and so the M&A business can obviously be played right in around these opportunity zones areas. This is not a debt program. This is all about equity, common equity, preferred equity. Certainly when you're trafficking in preferred equity, that's where some of the economic hurdles are capped out, total returns are capped out. Common equity is going to park that opportunity fund right along at the share table with everybody else. That opportunity fund is going to be 1%, 5%, 10%, whatever it is. This is for growth capital. So opportunity zone capital is not meant to buy out or pay dividends to existing partners. It's meant to expand the capital base by buying new shares or buying new partnership interests. It's not a way to get rich for the existing investors to put money immediately into their pocket. Still got to earn it. Restrictions come with this. The opportunity zone regulations, it's only about 100 pages if it's 1.5 spaced. Worthwhile to go through it, and we'll touch on that briefly. David mentioned that they like businesses that want to stay in the zone for 10 years. I say bunk. I say, you know, get the money into the business, get the business into the zone. And if things change down the road, if that opportunity zone business gets bought out by a funds problem to figure out what to do with it. I don't believe there are any tax failures or tax penalties. There's plenty of room for opportunity funds to either pay out that dividend or to reinvest the money. Sure, there may be a capital gains event inside of the fund. That's the fund's problem. That's the investor's problem. Certainly, if it's a great deal, they'll be profiting handsomely alongside of the other investors. So I don't believe that the handcuffs are required for businesses to stay in the zone for 10 years. This program goes on to 2047, which means that the forgiveness of tax capital gains goes to 2047. So when I talk to a business about it and investors about it, I want them to think about all the way to 2047 and look well beyond 10 years and to look at many of the ins and outs to capitalize on the program rather than to shaking their boots about a 10-year liquidation. Next slide, please. I touched briefly on the regulations. This is just another permutation of the slide I gave you before. The rubber meets the road between the funds, the qualified opportunity fund, and the qualified opportunity zone businesses. So they're connected by these regulations. The funds are looking to the businesses to stay compliant. The businesses don't have any tax forms to fill out for their tax returns. All the tax returns are prepared by the funds and the investors, but certainly the funds are going to be looking over the shoulder of the funds to make sure that those opportunity zone businesses remain compliant every 6 months or probably even monthly. So there's a rigorous ongoing compliance program. The burden is on the funds, but the opportunity zone businesses really need to understand the property is held, et cetera, et cetera. So several rules there are not worth going into right now, but the key is the interface on these tax regulations between the funds and the businesses. Next slide, please. I got about 5 more minutes here. Again, this is private equity with conditions. So David had the nice snake chart showing all your capitalization options from borrowing money on your credit card to borrowing money on your home equity to entering the more formal private equity world. And I would put this right up there in the private equity world. but with conditions, because there's a lot of conditions tied to geography, time, and tenure. I always advise businesses to get pre-qualified. So before you go down this path and get in over your head pursuing opportunity zone capital, make sure you're qualified. Make sure that you've been vetted. Make sure you've gone through some of the major conditions. Make sure that if there's a gray condition, that's how do we get around this, or how do we fix this? Make sure you know what that remedy is going to be in order to fix that condition. So if you need to have 70% tangible good property, new property in your business within a certain period of time, let's say you're moving a taxi fleet into an opportunity zone and you're bringing all the old cars with you. Well, at some point, you're going to have all those cars, all those taxis or cabs are going to have to be younger than January 1st of 2018, where they represent more than 70% of the total business assets. So you may have to have a rotation program, sell old and buy new, so that within a certain timeline, you're going to hit that plus 70% good asset test, and everybody will be happy. So do the pre-vetting, get pre-vetted on the qualification criteria, so you know where you're going to fly and where you know you need to cure. Understand the cost benefits. Private equity is not free. Opportunity zone capital is not free. At least I haven't seen any yet. So understand the cost of capital, the required rates of return, if it's preferred equity, if it's coming in looking for preference return. Understand specifically all those preference elements, what a preferred dividend means, what the total return top out means, et cetera, and understand the servicing costs, if there's any pass-through accounting costs, pass-through legal costs connected to the compliance program. So get visibility on all the costs so that you understand what the total cost of this capital is going to be. We talked about 10 years, 28 years. So is the business in it for a quick flip? Are you in it to start up a business and sell it in 3 or 4 years? I would say still opportunity zone capital can work for you, because at least the investors can get the deferred benefit and park their money into your business until 2026. So I think there's a short-term play for opportunity zone money. There's even a long-term play, but you got to make sure that your business strategy and the term of your business matches with the strategies of the opportunity zone money, whether they're trying to get the deferred short-term flip or the long-term forgiveness play. I covered number 5. Understand your maintenance requirements. Number 6, that's going to be read the regulations of the maintenance requirements that affect the opportunity zone businesses, and plan the exit strategy, not only for the opportunity zone, but for all investors. So if you're looking for that pharma Swiss deal to buy you out, and everybody's going to sell out, great. If you're looking for that day when you're going to cap out the opportunity zone investor so that you can greatly expand your footprint well beyond the opportunity zone and unshackle yourself from those opportunity zone benefits, plan that exit strategy so that you know what targets you're aiming for. Next slide is resources. I co-authored an article. Next slide. I co-authored an article specifically for businesses on some of these same talking points that I gave you. Food for thought. Read the regulations, read the code. Important. It's not a tough read, but Tucker and the other people after me are going to walk you through some of that stuff. There's no substitute for reading yourselves. Don't believe what other people tell you, because there's a lot of detail there. And opportunity zone map, get out and see the zones. I think that all this discussion has become abstract about talking about opportunity zones. Get out and drive them, whether you're a business owner or a real estate person or looking to invest, drive the zones and get familiar with it. There's a lot of interesting stuff out there. I was just on Colonial Boulevard here. It's right near my house, and a whole huge strip of vacant shopping malls I said, my God, somebody should do a video on that to attract investment capital. And you see this over and over again everywhere. So get out and find your business location. Get out and look for it, and then see how Opportunity Zone Capital is going to work for you and your business startup in the zone. Thank you very much. I look forward to your questions or your emails.
Yeah, thanks so much, Paul. And if any other questions come in for you, I will send them to you, and happy to get anybody in touch with you. All right, now we are going to turn it over to Tucker Toney, Associate Tax Attorney at Gray Robinson. He's with their Orlando office. Tucker, you there?
I'm here. Can you hear me?
Yep, loud and clear. Thanks for joining us today. I'll hand it over to you.
Sure. And I'm going to move quickly. I generally get about 45 minutes, and I don't get through all these slides. And Gray told me I think I only have 25 minutes today. So if I'm speaking very quickly, I do apologize. Next slide. I thought you deleted that. Next slide. Okay. Types of taxpayers and investments. The use of fund is a little misleading, and I'm pretty sure Grace spoke about this earlier. When we hear fund, we think of a mutual fund or a hedge fund, and you get sort of a Wall Street vibe, and you think, well, I can't go out and start a hedge fund. That's not for me. That is not, there are large pooled investments that are highly diversified with active managers and passive investors that are sort of looking for a coupon clipping type of investment. There are those springing up in the opportunity zone space, but they're few and far between, at least in my anecdotal experience out there practicing. I see a lot more of sort of single project opportunity funds. So you've got a business that you want to open within an opportunity zone, or a business that you're interested in layering some tax benefit on top of. Maybe it's manufacturing and it's not so driven by your location specifically, more regionally specific versus being on Main and Main. If you're in a manufacturing project and you determine I want to layer some tax benefit on top of that, or you're looking at a real estate project that happens to be in an opportunity zone. And once we find the project, we build the fund around it. And they're, in my experience, very often single asset, single business type of funds. You will, and the use of fund in opportunity fund was really that the fund was the funding mechanism to incentivize investment into these, underserved and lower areas that simply don't have the resources available to them. So for an opportunity fund is really any state law entity. It can be a LLC, it can be a partnership, it can be a corporation, but it does need to be a regarded entity for federal income tax purposes. And what I mean by a regarded entity is that it is not disregarded. And to be maybe a little bit more specific, a regarded entity has to file a federal income tax return, where a disregarded entity, which is a single member LLC, does not have to file a federal income tax return. So for both our qualified opportunity fund and the lower tiered entity called a qualified opportunity zone business, which I call a quasi-B, just sort of pronouncing the acronym, both of them will need to be regarded entities. Very often a partnership, maybe an S Corp. Sometimes we see some C Corps. In terms of the type of, moving down to the second bullet on the left side, the types of taxpayers that are eligible to invest in opportunity funds. So this isn't the fund or the quasi-B itself. This is the owners of the fund, the people that are eligible to appreciate the tax benefits associated with opportunity zones, is any entity or individual that pays capital gain. If you pay capital gain, or you're as an entity or an individual, you're eligible to participate in the opportunity zone program. As Paul mentioned, and I'm sure some speakers before me mentioned, only equity investments qualify for the tax benefits associated with opportunity zones. That doesn't mean you can't use debt, and for most of these projects, you're going to want to use a healthy amount of debt for reasons we'll discuss in a little bit. But you can't invest as well. If you loan money to the company, that loan, the interest coming off of it and the principal going in is not going to appreciate the tax benefits associated with opportunity zones. There'll be no deferral associated with the capital that gets loaned to the company. And whenever the loan gets paid back, even if it's after 10 years, there's not going to be a basis step up of some sort. It doesn't really even follow that well with a loan. But in any event, it's only equity investments that are going to get the deferral and the basis step ups, which I'll discuss here in the next couple slides, associated with opportunity zones. And while we are stuck with strictly equity investments, you can use preferred stock and special allocations and partnership agreements. And certainly, those are great benefits when you're out there doing projects, especially development projects or new businesses, where you can give certain investors a better return on their capital than others. That is still available within the program. And as I said, that final bullet, you will need debt in most of these projects. And the reason is your capital, when it comes in, to the extent that it was opportunity zone capital that you got deferral for, is going to start with a zero basis. So it's a little bit awkward and different than most of my clients are used to, because they're used to getting cash basis in their equity slug that they bring to the table, right? So you're going to start with a zero basis in the cash that you put in, to the extent it was deferred capital gain. So for that reason, having a good, healthy amount of debt gives you some basis. And if it's a real estate project, get all the nice tax shelter associated with depreciation deductions and the other benefits associated with having basis in a business. Next slide. Okay, so I look at the tax benefits in really, there's three tranches, but they come in kind of two flavors. The two flavors are an income tax deferral, and the other flavor is a basis step up. Now, there's two different types of basis step ups, and even though they're the same kind of tax technique, tax benefit, they are very different in their operation and really should be looked at as separate tax benefits. I think people get confused when they commingle those basis step ups and don't understand how distinct they are. So we'll start with the income tax deferral. Deferral is an income tax concept most people are familiar with. The kind of the classic archetypical deferral is a 1031 like kind exchange, which most people are familiar with. Deferral doesn't mean tax avoidance or exclusion. It just means you get to pay it at a later date. You defer paying taxes today, and you'll pay them sometime in the future. And if you're anything like me, I'd much rather give you $1 in a week than I would get to give you $1 today. And if I give it to you in 10 years, even better. So what we allow with income tax deferrals, if you recognize capital gain, and this is capital gain unrelated to the opportunity fund. This is you sell some stock, you sell a piece of land, you recognize capital gain. You can either pay tax on that gain, or if you put it into an opportunity fund, you can defer paying taxes until some later date. And the way we calculate the value of deferral is just the time value of money, the time value to the tax I didn't have to pay, right? So it's going to allow you to grow your business quicker because you have more capital to reinvest, because that capital was not reduced by your tax burden, right? So if I can keep deferring, I keep my capital out there larger until a later date. The opportunity zone tax deferrals is slightly different than kind of the 1031 tax deferral. Most of my clients that do a lot of 1031 work are looking to 1031 or and never pay tax until they die. Take the nice big basis step up in the sky and leave their kids with property that they can sell and walk away with all the cash tax free. In that sense, 1031 tax deferral does not automatically end until you dispose of the property without a subsequent non-recognition deferral event. So with opportunity zone tax deferral, as it's written right now, that tax deferral is going to end at the earlier of when the investment is sold or there's another inclusion event. Inclusion events are long and convoluted, and we won't put you to sleep with them today, but just I want to make a point to say anything you're doing, if you have an opportunity fund, whether it's a refinance, it's a sale, it's an assignment, really anything you're doing, you need to go talk to your tax advisors before you do it, because you may inadvertently trigger an inclusion event unwittingly and get hit with a tax bill, which nobody wants. So just keep in mind that your deferral can end upon events that you may not fully think of as a disposition or a sale of your membership interest or your stock in the opportunity fund. However, even if you don't sell anything, you're perfect in your operation and you never trip up on an inclusion event, as the law is written right now, your deferral is still going to end December 31, 2026. That's sort of our hard inclusion date. There were some rumblings early on that date was just for scoring purposes and that date could get pushed out. I am not relying on that, and I don't advise any of you to rely on that date being extended. I would keep it in mind as a hard inclusion date and plan for it. Note, and the note there at the bottom is really germane in the current context. That why the deferred gain is included, when I mean included in December 31, 2026, when you take it back into income with the same attributes when initially deferred, right? So if it was deferred as short-term capital gain, you're going to include it as short-term capital gain on December 31, 2026, even though that might be, 6 years later. You don't get any carry time to convert short to long-term capital gain. Your hold time is going to be the same, and the other tax attributes would be the same. However, big however, the tax rate applicable to the gain is going to be the tax rate at the date of inclusion. And with the recent stimulus that has gone on and the way the elections might be shaping up, certainly if candidate Biden wins, Vice President Biden wins, he's already indicated he wants to raise taxes. He wants to end 1031. He wants to raise capital gains. So you might find yourself deferring at a 23% rate and including at a 35 or 40% rate. So it's something to keep in mind. In the projects we've been putting together recently, we've certainly had that potential tax increase in mind, and we're working on strategies to sort of force inclusion events if we want to kind of pull the ripcord and get out, because we think that the whipsaw on the tax rate might hurt too much. So there are ways to plan around it, but just keep in mind that is a very very tangible reality right now that you could end up with a higher tax rate at the date of inclusion. Next slide. Okay, other tranches of tax benefits are the basis step-ups. So what is basis? Why do we care if we have basis? Basis at its most simplest is what you paid for an item, right? It's what you got into it. Now that is really called the cost basis, the basis you pay for it. Your basis adjusts, it goes up and down based on various things that you do. If you make improvements to a piece of property, very often your basis will go up. If you take depreciation deductions, very often your basis goes down. So we don't look at our cost basis as the end all be all. We look at the adjusted basis at the time of sale based on those various items that can adjust your basis. Why we care about basis is it offsets proceeds from a sale or amount realized for the purposes of calculating taxable gain. So if basis throws people for a loop sometimes, but it's really kind of intuitive. If I told you bought something for 50 and sold it for 100, most of you would intuitively know your gain is $50. But if I told you your basis was 50 and your amount realized was 100, very often people can fall apart. They're just terminologies put on things that you likely already know. So we want basis so that when we go to sell, we pay less gain. The more basis, the better. Less basis very often ends up in more taxable income. So the way the basis step-ups work is there's two different ones. I kind of labeled them the intermittent basis step-ups and the fair market value basis step-up. So the intermittent basis step-ups, there's two of them. And this basis step-up is with respect to the initially deferred capital gain. So if you put in $1 million of initially deferred capital gain, your basis step-ups are going to be based on that initial capital contribution. So after 5 years of hold time in the opportunity fund, you'll get a 10% basis step-up. And I've got some examples on the next couple slides that'll kind of walk through this. After 7 years, so that's an additional 2 years after the 5 years, you'll get another 5% basis step up. So the net is 15% basis step up after 7 years. With our example of $1 million of deferred capital gain, that ends up with $150,000 of basis after 7 years. Keep in mind though, for taxpayers that invested after December 31 of 2019, you're not going to get that extra 5% basis step up, simply because our December 31, 2026 hard inclusion date is going to come before December 31. I mean, it's going to come before 7 years can expire if you made an investment in calendar year 2020 or later. While don't get too upset about that, it doesn't end up with that much of a tax benefit loss. It really generally only results in about a 1% reduction in after-tax savings. And for those doing your math at home, it's listed here in the bullet points. For every $1 million deferred capital gain, if we assume a 5% or the 5% basis step up equals 50,000 in basis, right? That is what 5% of 1 million is. How do we value basis? So the value of basis is you take basis times whatever the applicable taxable rate is, and you figure out the after-tax value of that basis. So if we assume a 20% tax rate, capital gain that was unrelated to the net investment income tax, then we're talking about for every $1 million deferred capital gain, $10,000 in after-tax value is lost by not getting that 7th year extra 5% basis step up. $10,000 is nothing to scoff at, but it's certainly not enough to steer you away from an otherwise good investment. Keep in mind that the after-tax value of the 5% basis step up will increase as the tax rate increases. So for short-term capital gain, unrecaptured Section 1250 gain, or capital gain subject to the net investment income tax, it's going to be slightly more than $10,000 in after tax, and with short-term capital gain, it could be substantially more. Again, the only analysis, the only way you change the analysis here is when you take your 50,000 a basis, instead of multiplying it by 20%, you might be multiplying it by 37% of its short-term capital gain, or 25% of its unrecaptured 1250 gain, or 23.8 if it's got net investment income tax. So as you can see, that necessarily raises the after-tax value. The other basis step up, and really the reason that we're having this conference and everybody's very excited about opportunity zones, is the fair market value basis step up. So this, while it's also a basis step up, is not directly related to the initially deferred capital gain. This is with respect to the fair market value of your interest in the fund as determined at the time of sale that occurs at least 10 years after you made the initial investment. So if year 12 rolls around, you made that initial $1 million investment, and now it's worth $10 million, and you go sell your fund shares for $10 million. At the point of sale, you get a basis step up to $10 million, and you'll walk with all of those cash proceeds tax-free. Okay, and the final note at the bottom, we talk about a lot of tax benefit associated with opportunity zones, deferral, basis step-ups, and what can often get lost between all that is that the fund itself in the qualified opportunity zone business is not a tax-exempt entity. The operating income earned by the fund, whether it's rental income, whether it's from selling widgets or providing some service, that operating income is taxable like any other business would be taxed. And you've got to you just got to keep that in mind. That any of the operating income is not going to be subject to these tax benefits or really appreciate any offset based on the opportunity zone tax benefit. You'll still get, if it's a real estate business, you'll still get depreciation deductions and your normal tax shelter from those, and same to the extent you're an operating business with equipment. There is still, you operate it like a normal business layered on top of about 1,000 pages of Treasury regulations for the opportunity zone benefit. Next slide. All right, here's our tax savings example. I'm going to kind of rip through this. So we got an investor that sold some stock on August 1, 2018, generating $1 million in capital gain. Instead of paying $238,000 on that gain, instead of paying $238,000 tax on that gain, leaving her with $762,000 to invest, the investor can invest the full $1 million in opportunity fund, and the investor determines to make that on December 23rd, 2018, which is within the 180-day period. At the time of the investment in the qualified opportunity fund, the basis in the qualified opportunity fund stock is 0. And why? Remember, it's because this is deferred capital gain. You didn't pay tax on it, so you're not getting a cash basis in it. You're getting a zero basis in the cash that's brought in. After 5 years, the basis will increase to $100,000 because of the 10% basis step up. And after 7 years, it would increase to $150,000. Next slide. Okay. Now we assume the investor sells the stock on December 31, 2022, which is less than 5 years after making the initial investment. The sales price is $2 million. You got a zero basis, so net taxable gain is going to be $2 million. So this is $1 million of appreciation and $1 million of the initially deferred capital gain. The investor waits until December 31, 2023, 5 years after the investment. The investor is going to get that $100,000 of basis. So same $2 million purchase price, they get $100,000 of basis, and taxable income is going to be 1.9. Next slide. Our investor in this example invested in 2018, so it was prior to the cutoff of getting that 7th year extra 5% basis bump up. So our investor will get that. And at that point, if they had a sale after the 7th year, they would get $150,000 of basis and pay $1.85 million in tax. Now here's our phantom tax issue with our hard inclusion date of December 31, 2026. So if the investor determines not to sell at those prior dates and holds the stock beyond December 31, 2026, the investor is going to take the initially deferred capital gain into income, even if there's no disposition. So you got to think about that, and especially if you've got investors. December 31, 2026 rolls around, and on the K1 that year, there's an extra $1 million flowing through to all the partners. They may not have a corresponding cash distribution to pay the tax on that, and that's going to be a investor issue for you, because nobody likes to get a K1 with taxable income allocated without a corresponding cash distribution. And even though you could go back to your investors and explain, hey, you didn't pay tax back in 2019 or 2020 because of my great opportunity zone program, and you got involved, and this is really just you making up for that not paying tax back then, and hey, I got you 7 years of not paying tax, and that lets you grow your investment even larger. But in my experience, well, not necessarily experience, but my experience with investors and me guessing of how that's going to look on December 31, 2026 is it's going to feel old and cold to your investors. It's going to feel like phantom gain, and they're not going to care what happened 7 years ago. They're going to care what's going on right now. So the way we've been handling this, just sort of like any other known liability, future liability, is we've been funding it with a reserve. So we pretty well know what the highest we know what the highest tax rate is now. So we're funding a reserve that will be able to make a tax distribution on December for the 2026 tax year to cover this phantom gain issue. So if you can imagine how that would look, if this $1 million got passed through and we assumed it was still a 37% tax rate, we would have a reserve of $370,000 that we would distribute out to the investors pro rata, so that when they got that $1 million of phantom gain, they got a corresponding cash distribution they could pay the tax on it with. Next slide. All right, when the investor finally sells the qualified opportunity fund stock in 2029, and this is more than 10 years after the initial investment, the investor gets a basis step up equal to its fair market value. And you may say, how do we determine fair market value? Do we have to go get appraisals? Well, it's at the point of sale. And the clearest definition of fair market value is what a willing buyer will pay, being under no coercion and being reasonably apprised of the facts, right? So if these are an arm's length transaction between two parties, it's going to be very difficult for the IRS to challenge the sale price as the fair market value. Not to say they might not, or that there might not be some tomfoolery going around to try to gross up that basis step up, but in general, I think this is going to be pretty unassailable by the IRS, as long as, again, it's an arm's length transaction. Next slide. Okay, the asset test. So an opportunity fund has to own 90% of its assets in qualified opportunity zone property. And there's really two types of qualified opportunity zone property for a fund to own. It's either an interest in a quasi-B, so they can either own shares or membership interest or partnership interest in a qualified opportunity zone business, or they can own the zone business property directly. For reasons that I'll get into, and I think my friends at Eisner Ampner, Carol and Steve will get into a little deeper. Most businesses, most opportunity zone projects are going to find it advantageous to own their hard tangible business property, the zone business property, through a quasi B rather than owning the property directly, the tangible business assets directly, and I'll explain why. But keep in mind, up at the fund level, of our top level up there, the QOF level, that has to hold 90% of its assets in either quasi B interest or zone property. If it fails that 90% asset test, there's a pretty testy penalty that waiting for a fund that runs afoul of that. Next slide.
Hey, Tucker, we're about out of time.
Okay. Let's skip this one because they'll touch it on Eisner Ampner. Okay. The last thing I want to leave you with is on the two-tiered. As I discussed, most taxpayers or most opportunity funds are going to find it advantageous to structure their investment as a two-tiered quasi-B structure. And what I mean by two-tiered is you've got the fund up top owning a quasi-B, and then the quasi-B owns the hard business assets directly. And the two reasons that we go there are there's a lessened asset test if you use the two-tiered quasi-B structure. So the fund has to own 90% of its assets in opportunity zone property. However, the quasi-B only has to hold a substantially all of its assets in substantially all of its tangible business property and opportunity zone property. Substantially all is defined as 70%. So when we stack that up with the 70% down at the fund level or quasi-B level and 90% up at the qualified opportunity fund level, you end up with only about 63% of the net assets having to be, or the net tangible property having to be opportunity zone property, which is a big benefit as you'll understand after Steve and Carol's presentation. It's not so simple to qualify property as opportunity zone property. Just simply lying within the opportunity zone is not enough most of the time. The other benefit of the two-tiered quasi-B structure is you get access to the working capital safe harbors, which Steve and Carol will explain expertly. The working capital safe harbors are necessary for almost all opportunity zone projects, really because of the substantial improvement criteria, and to a lesser extent the original use criteria, really make it almost impossible to pull off one of these projects without penalty unless you use the working capital safe harbors, and they're not available to an opportunity fund. They're only available to a qualified opportunity zone business for whatever reason. Gray, flash the next slide just so I can show the structure, and then I'll get off. I'll go one more. One more. There we go. Okay, so our two-tiered entity structure back. Okay, two-tiered entity structure. We got the fund up top owning a quasi-B, and the quasi-B owns zone property. As you can see, if we had just over 11 million in total assets, we'd only have to hold 7 million in zone property down at the bottom of the quasi-B, because even though the quasi-B has 3 million in other property, because 70% is zone property, all of the assets of the quasi-B, the quasi-B interest is considered zone property for opportunity fund purposes. So the fund gets to, check off its 90% by just having 90% of its assets held in the quasi-B, even though down below the quasi-B, it may not all be zone property. That's the real benefit from an asset test perspective of going the two-tiered entity structure way.
All right, Tucker, I'm going to allow you to make one last comment about these caution marks on this slide.
Yes, this and the previous diagram that showed, these are not, I'm trying to make a salient point of what an opportunity fund structure looks like. What this asset test looked like, and on the prior slide, what a two-tiered versus single-tiered entity structure looks like. But don't go out and create a fund project with just this in mind. There's a lot more that's going to need to go into it. If these were both S corps, it would probably work. But very often, to qualify or to check off that regarded entity requirement, we're going to need some other entities involved to make everything a partnership or whatever other entity we might make it.
So what he's saying is call your tax attorney or your CPA and get some help.
Yeah, this is people say this is the Wild West, but it's no place to cowboy up and go alone.
All right, thanks so much, Tucker. Thanks for the time as always. Now we're going to hand it off to Stephen and Carol from Eisner Ampner. There we go. All right, Stephen, Carey, y'all on the line?
Yep, we're here. Thanks, Greg.
All righty, y'all take it away.
Okay, next slide. Eisner Amper is a national accounting firm. We have offices down here in Miami and Fort Lauderdale. So we do tax auditing, consulting, and have a heavy emphasis on the opportunity zones. Definitely here to help anyone that needs it. Next slide. So I think we're the probably the fifth presenter that's going to go over some technical material. Good news is we're the last ones to go over the technical stuff. So we're going to try not to repeat anything that's been said already and make it pretty quick and painless. So our focus is going to be on the regulations that were released in December of 2019, and also on a recent notice relating to COVID, some additional relief that was granted in June. Next slide. We could skip this one. Next slide. So, a few of the presenters have talked about the 180-day reinvestment period. Again, the notice that came out in June, it actually extended the 100-day period for any period that falls between April 1st and December 31st until December 31st. So theoretically, if you had a period that started in December, normally would end, at some date in May, now you have to the end of the year, but you do have to claim it on your timely filed tax return. So for most people, that's coming up October 15th. If you do have a fiscal year entity, you may get to the end of the year, but in most cases, the extension runs out on the 15th. Next slide. And so one of the key parts of regulations that came out with the 180-day rule was it said any gains that you have from a partnership entity. So whether you hold real estate with a family member in a partnership, or you invest in a hedge fund or a private equity fund, any gains from those K1s, you have until 180 days from the end of the tax year, or they even went further and said from the due date of those tax returns. So theoretically, most of those returns are going to be due March 15th of any given year, and you'd have 180 days from there to reinvest. So a gain that the partnership had in January of 2019, theoretically you could have till middle of September of 2020 to reinvest, and that's not a one-time thing. That's every year. As long as the law is active, you have that period of time to reinvest from partnership. So that was a very generous provision that they put in. Originally, it was just 180 days from the sale of the assets, which would have been a lot more limiting and very difficult for partnerships to pass along that information. Next slide. And so another favorable clarification that they made in the regulations was they basically said any 1231 gain will qualify. And just for simplicity, 1231 gains are often resulted when you sell rental real estate, also when you sell some other business assets. So, they are very common, and the original rules, there wasn't clarity whether they would be included, but they made it clear that they will be included in almost all cases. Now I'll let Carol continue with the next slide.
Can you hear me now?
Yep, you're good now.
Okay, sorry, I was muted. Okay, so I'm going to go over the next set of slides. I'm going to talk a little bit about debt refinance distributions. So as we've talked about before, the investors, they usually have that zero basis going into the QOF investments due to the ultimate tax benefits through the special basis adjustments for the 5, 7, and 10-year holding period rules. And these final regulations clarified that the normal debt allocation rules in Section 752 of the Internal Revenue Code do apply as confirmed in the earlier set of proposed regs. There was some question from the proposed set of regs if they would apply, and these final regs did give us clarity. So just to give you an example, of the partnership or a lower tier partnership takes on debt, the upper tier partners will get their allocable share of that debt. And by having basis in debt, This allows the partners to receive distributions up to their basis without triggering a gain or an inclusion event. And as Tucker went through those inclusion events, you got to be very careful to not trip anything up, or you could have a tax consequence. So with that being said, though, when we're talking about distributions, we have to be mindful of the disguised sale rules. And again, just keep in mind that this program was intended for long-term investments. And so under these disguised sale rules, if you put money or property in and get money or property out within 2 years, you're going to have to worry about these rules. You can have a taxable event. Something very important to note is that under these rules, not only can the distribution be taxable to the investor, but it can also invalidate the investment by the investor, and that would be catastrophic in as far as the QOF would not be eligible at all. Next slide, please. The 10-year benefit for property sales. So as we talked about, that is like the home run here, is a 10-year holding period for the tax-free exit. And as long as that investor has the holding period of 10 years, then upon that sale, there's that step up to the fair market value, and the entire gain is excluded from taxable income. So initially, when these rules first came out, and in order to have the benefit of that 10-year hold, the investor needed to sell his interest in a QOF. So, for instance, a partnership interest in the qualified opportunity fund that he invested in. But now, under the final regs, that investor has that has held that qualifying interest for 10 years can not only exclude the gain on sale of the interest, but also can exclude the gain on sale of assets that may occur within the partnership. So that is also a very big benefit that the investors receive there. So it's not only the gain on sale of the partnership interest, but the assets. So initially, the market was pretty much focused on a single asset QOFs for the most part, but the sponsors wanted that diversity with the multi-asset funds, and now this is much easier to accomplish. Also wanted to point out that multiple contributions over time by an investor results in multiple holding periods by the same investor. So for example, you have an investor that invests gain in 2019 and gain in 2021, and let's say a sale occurs in 2030. So that investor is only eligible to claim a 10-year benefit on a portion of that gain because he has not really held his entire investment for the total of 10 years. Next slide, please. So the QOF structuring, there's much more flexibility with these final regs. They clarify how QOF restructurings are treated under inclusion event rules and now provide a lot of flexibility. So mergers of QOF partnerships will not trigger an inclusion event so long as the surviving partnership is the QOF. The final regs confirm that a contribution of a QOF interest to a partnership in a tax-free transaction is also not an inclusion event. And just keep in mind that there's additional rules for S Corps and C Corps that I won't get into. Next slide, please. So the QOF holding period rules. If a QOF owns equity in a quasi-B, that quasi-B must be a good quasi-B for at least 90% of the QOF's holding period. And again, the IRS selected that 90% investment standard to encourage that long-term direct or indirect investment. That test is applied cumulatively, and the test occurs twice a year, semi-annually on June 30th and December 31st. The regs give you some flexibility through the safe harbor in that June 30th testing date. You can rely on your status as of the end of the previous year. So that's a benefit there. And you can only get a one-time cure if you blow that test, and that needs to be done within 6 months. So under the COVID notice 2020-39, it provides that in the case of a QOF whose last day of the first 6 months of period of that taxable year, or the last day of the taxable year falls within April 1st and December 31st of this year, any failure to satisfy that 90% investment standard is deemed to be due to reasonable cause, and this relief is automatic. Next slide, please. So voluntary decertification, very, very interesting and really good relevant points that Tucker brought up. You know, that there may be many instances now why you may not want to continue with a QOF. So when this happens, the QOF may voluntarily elect to decertify. So for example, a QOF sold their property and they know that they are not going to want to reinvest at the fund level. They may want to decertify so that the investors can basically reinvest maybe somewhere else before 12/31/26. That's another reason why they may want to decertify. The decertification will be an inclusion event for the investor, and please keep in mind that the investor has 12 months to invest the deferred gain in another QOF in order to defer that tax. Next slide, please. So we have a working capital safe harbor, and these proposed regs provided the quasi-Bs are allowed to hold a significant percentage of liquid assets, which are cash equivalents, or short-term debt, which is 18 months or less, without violating the non-qualified financial property rule and other requirements. So no more than 5% of your assets can be cash or other financial property, but you can have a reasonable amount of working capital. So this 31-month working capital safe harbor is for investments in quasi-Bs, not at the QOF level, but at quasi-Bs, and it's for to acquire, construct, or rehabilitate tangible business property, which includes both real property and other tangible property used in the business operating in the quas. So to be eligible for this working capital safe harbor, there must be a written plan with a reasonable schedule of development and deployment, or consumption of capital that is in line with that schedule. And this safe harbor can also be told if the quasi-B was waiting for governmental action, such as permitting or zoning. And as a result of the pandemic, now the regulations allow for an additional 24 months. So essentially all quasi-Bs created prior to 12/31/20 now have a minimum of 55 months and as much as 86 months for start of business. Next slide, please. So the gross income test, the final regs, they came out with a safe harbor for quasi-Bs, and that included 50% of the gross income of the quasi-B had to be derived from the active conduct of a trade or business each year. And this was really potentially limiting for many businesses with, for example, multi-state, national, or even international sales to get to that 50% requirement, gross income requirement, and that was on a yearly basis. So the final regs provided these 3 safe harbors and a facts and circumstances test, which are listed in this slide. So as you can see, this is very taxpayer favorable, and even if you don't meet any of these 3 requirements under a facts and circumstances test, you can still get there. So that was a big benefit for businesses, not necessarily for real estate, because you hear about a lot of the qualified opportunity funds is in the real estate space, but keep in mind that for businesses operating in qualified opportunity zones, this is something to keep in mind. I'm going to turn it back over to Steve now.
So just to hit on the working capital safe harbors, you can have different safe harbors within a period. So you get money in on January 1st 1 year, and then June 30th the following year you could get another tranche of money. Each time you do it, you need to have your own. As Carol said, you need to have a business plan. It doesn't have to be a formal business plan, but you do need to have a plan for how you're going to spend that money. But you can keep doing this for up to 80, under the normal rule, 62 months, and if you get the additional extension, 86 months. So again, they give you a lot of flexibility and, potentially growing a business and understanding that, you're not going to deploy all the capital on day one. Next slide. So the original use test, is next slide. We're going to talk about substantial improvement, which was touched on by some of the earlier presenters. But the original use test says that you don't need to do any substantial improvement. If you have a property that qualifies, you could just continue the property there's no minimum requirements for reinvestment in the property above and beyond your investment. So they lowered, this was originally 5 years, and they lowered it to 3 years to help motivate properties that have been neglected to be more attractive for this program. Next slide. So the substantial improvement, is when, if you buy a building for $1 million and the land is worth 200,000 of the million, that 800,000 building cost, you'd have to, if it doesn't qualify for original use, you'd have to reinvest an additional 800,000 to improve the property. They didn't want just property turning over, without substantial improvement being done to it. So the regulations came along, and again, in a favorable way, they said that if you have properties that are next to each other and essentially working together, you don't necessarily have to improve each property building cost by 100%. You just need to improve the total of the two, or the total of the whole property by 100%. So again, they offered a flexibility, and there's some requirements for what properties can be included in this, but again, they made it more flexible. And you have 30 months to make the improvements. And again, for the COVID relief, they said any period from April 1st to December 31st doesn't get counted in that 30 months. So essentially, based on when this law started, everyone gets an additional 9 months. So it's really 39 months for any projects that started prior and to April 1st. Next slide. And now I'll hand it back to Carol to finish off our presentation.
Thanks, Steve. So I'm going to go over lease property. This was also a really big value add here for this program, and you're going to see it in some examples I'll give you. So leased assets are included now in the determination of the quasi-B property for the purposes of meeting that 90% asset test requirement at the QAF level and the 70% substantially all requirement at the quasi-B level if the tangible property is acquired under a market lease after December 31st, 17, and substantially all of the use of that leased tangible property is in the quas for substantially all of the quasi-B's holding period of that leased tangible property. So the lease can be from an unrelated or a related party. And if it's unrelated lease, you need to show that at least that it's at an arm's length lease. So for example, if you have a building or land that was acquired before enactment date of, so say on December 31st, 17, and you lease it to a QAF that you own, it now qualifies as a good asset. And this allows for a lot of flexibility. There's also no original use or substantial improvement requirement, the requirements that Steve was just mentioning. I want to point out that this really does solve the problem of existing structures that you acquired before enactment date. So if you had a piece of property that you had a building on it and you acquired in December 17, which was prior to that date, you transferred it to a QAF and you spent, say 90% of your original cost fixing up that property. It's not qualified according to the regs. However, now by leasing that same property to the fund, that leased property is a qualified asset, and all of the improvements that you make are also qualified. So you would now have a situation where it did not qualify at all. Now it's 100% qualified just by leasing that property to leasing it as opposed to any other sort of structure. Next slide, please. SIN businesses. So this is at the this only applies to the quasi-B level, not at the fund level, and it basically says that you cannot operate a SIN business, which includes, for instance, like country clubs, golf courses, massage parlors, and the final regs did provide for a de minimis rule of 5%. So an example, simple example is a hotel that has a spa and it offers massages, right? So you can do it as long as it is a de minimis amount. Next slide, please. Something to mention the straddling rules. So for purposes of the quasi B requirements, rural property straddling, you could have a situation where you have a property straddling an opportunity zone. And it will be now under their final regs be considered entirely in the zone if the property in the zone is greater than the property outside of the zone. And these rules can also be used to satisfy the 70% test. Next slide. Anti-abuse. So the final regs include a statement for the purpose of the quasi-B, and the final regs include anti-abuse language. So basically this language states that if a significant purpose of the transaction is to achieve a result inconsistent with that purpose, then the transaction may be recast or recharacterized. So if you're putting money into a zone and you don't really intend to use it in that zone, you do not have a good qualified opportunity fund. Next slide, please. Future guidance. The preamble to the final regs specify the following issues that may be addressed in the future guidance, which are listed here. And there's no timetable for when they will come about with future guidance at this time. Next slide. And that is it for our presentation. I don't know if there is any questions. We'll be happy to answer them. Our emails are on there and our information.
Carol, there's a question that has kind of been answered, but maybe just touch on it again. May an existing entity be converted into a qualified opportunity fund?
The existing entity can be converted to a qualified opportunity fund.
Okay, there you go, short and sweet. Thank you so much. Thank you and Stephen both for presenting. Always appreciate the content, and anybody that has any questions, there you go. There's a slide with your contact info. There's Carol and Stephen's emails there, as well as phone numbers. Shoot them an email and ask them questions and have them take a look at your project. All right, thanks y'all.
Awesome, thanks.
Okay, with that, thanks so much. I know we are running a couple minutes late. I appreciate that, but I think some of the later presenters, we allotted a little bit more time than they really need, so that should be fine. But the next presentation, let's get it loaded up. There we go. It's going to be the SBA out of the South Florida District Office, Althea Harris. Althea, are you on the line?
Yeah. Oh, yes. Hi. You're perfect timing. I was wondering, I joined with my computer and I was worried that you wouldn't know that, but I'm glad the technology is such that you could do that. Thanks so much, Gray. I'm glad to be here and being able to talk about opportunity zones. They really are an opportunity. And I do hope that your listeners are able to take advantage of the opportunity, because it's so important that we, in fact, revitalize these economically distressed communities around the country. And opportunity zones are a way to get that done. Next slide, please. Before I talk about SBA and opportunity zones, I just thought I'd tell you a little bit about myself. Again, I'm Althea Harris. I have over 27 years of federal service. I started in my hometown of Washington, D.C. at the U.S. Department of Commerce. And then I moved over to the GSA, the General Services Administration. And then finally moved to Miami once I got married to Mr. Harris, and I started working at the SBA. I went to school in my hometown, Howard University, and then I went to law school here at the University of Miami. Woo! And go Canes. And we have 4 beautiful children. That's my dog. He's a Rhodesian Ridgeback, and my running partner. We run in the mornings. And I do like to read, and I have a magnificent kind of tropical garden, not like an herb garden. And so I like to go out there and pull weeds and just enjoy outside. That is my email address. I welcome your questions or your interaction through email. And so that's a little bit about me. I've been at SBA for 21 years, and I can stay this long because I like what we do, and I like who we do it for, and I like my colleagues. So with that, I'll ask for the next slide, please. So why do I like SBA? Because we help entrepreneurs start, grow, and succeed in business, and recover after disasters. And a lot more people know about SBA now because we are the go-to source and resource for disaster assistance because of the pandemic. And you know, as you may know, we did over 5 million paycheck protection program loans. With Treasury's help, we did over 5 million. We have and continue to do economic injury disaster loans to small businesses to help them make it through the pandemic. Where there have been hurricanes and earthquakes and fires and tornadoes, SBA is there to provide that long-term disaster recovery. So, but you may be wondering, you know, well, what does SBA have to do with opportunity zones? Well, I'm going to tell you. So these are the 4 pillars that we stand on. We provide access to high quality counseling, coaching, mentoring, and training. We provide access to capital, as I mentioned, disaster loans for homeowners, renters, and businesses. And of course, we help small businesses who want to access the federal marketplace. So I'll go into more detail about that in just a moment. Next slide, please. Oh, and Gray, you want me to be done by 3:20? Get you back on track? Would that be, okay, I'm gonna do that. Okay.
Unless you have more to say, that's your call. We can run a couple minutes late if you need to.
Okay, very good. I'll do my best. All right, so you've heard a lot today, obviously, about opportunity zones, the qualified funds, all the different nuances with respect to opportunity zones. And clearly the major thing about opportunity zones is the money. And so SBA can be a part of the what is sometimes called the capital stack, like how you gather your money to do what you want to do in an opportunity zone. So for example, if you're going to invest in a business, but the fund isn't going to go all the way to do build out or buy the inventory or whatever, there may be limitations on how far an opportunity zone fund can go in terms of the investment in a small business. Well, the SBA, one of the major things we do that folks know about is we provide loan guarantees to businesses. Well, actually to banks who make loans to small businesses. And our 2 major loan products are the 7A products, which is our flagship product, and most loans are done through the 7A program. With 7A loans, they go up to $5 million on a loan. You can do all of the things that are listed below. You can purchase equipment. You can refinance certain types of debt. You can buy real estate. You can pay your accounts receivables and inventory. You can even finance a full change of ownership, making leasehold improvements. You can use 7A loans for exporting. So it is a very versatile loan product, and maybe you'll need that in combination with your opportunity zone funding on your investment in a business. The 504 loan program dovetails quite nicely with opportunity zones because, of course, the 2017 Tax Cuts and Jobs Act was passed and designed to increase economic development and job creation through the unleashing of private capital into long-term investments. Well, the 504 loan program is a long-term loan where you must create jobs in order to have it. So it goes quite nicely with opportunity zones, and it is for real estate acquisition and heavy machinery and equipment acquisitions. So it is not as versatile as the 7A, but it also does go up to 5.5 million and for SBA's portion. So when you just do a straight deal on including a 504, your total project can be valued at about $12 million. So it's a useful tool for growing an opportunity in an opportunity zone. Next slide, please, or rather financing one. So among the other things that we do is in the government contracting arena. The United States government spends over $800 billion every single year in contracting. Why? Because the federal government does not make anything. We are the world's largest consumer. So we are looking at doing business with businesses located in historically underutilized business zones, hub zones, and opportunity zones typically overlap with hub zones. So businesses that are located in hub zones enjoy advantages other businesses do not. Among those are a 10% price preference. So a hub zone contractor can bid to up to 10% higher on a contract and still win it. So opportunity zones, as I mentioned, overlap with hub zones very often, and I'm told you can petition SBA and your governor to recognize an opportunity zone that is not yet a hub zone and get it qualified as a hub zone. Why is that important? Because the federal government does not make its annual goal to do business with firms located in hub zones. So the federal government is incentivized to meet that goal. And so if you invest in a business in an opportunity zone, you set up a business in an opportunity zone that is also a hub zone, you're maximizing the benefit for that business to do business with the federal government. Next slide. And so, yeah, you need a certification for hub zone. And the important thing about hub zones is it does not matter who owns the business. Most of government contracting at the federal level is concerned about the demographics of the owners of a small business, whether you're Black or white, female or male, whether you're a veteran or disabled veteran. Hub zones don't care about that. All hub zone certification cares about is where your business is located and how many of your employees at that hub zone business also live in a hub zone. So those are your considerations with hub zone, and there are great advantages to being a hub zone firm. So consider that, especially if you're looking to locate your business in an opportunity zone or hub zone and you want to do business with the federal government. So one of the things that we do through our resource partners who are listed here on this slide, SCORE, the Small Business Development Centers who are hosting this session today, the Women's Business Centers and the Veteran Business Outreach Centers across the country, is what we're doing through our resource partners is endeavoring to increase the confidence and business knowledge of entrepreneurs to maximize their success in business. Now, the mentoring, the counseling that is offered through our resource partners is always, always free. Now, you may spend a nominal fee on training. Sometimes there'll be very specialized training like, learning to use QuickBooks or something like that. And then you might pay a nominal fee and you might pay some kind of fees for materials. But other than that, they are a great source of high quality counseling and information on every aspect of business ownership, whether it's you want to get into marketing or social media marketing, you want to export and you don't know how to do that. If you want to figure out how to find your employees, how to find them, how to keep them, where's your customer, things like that. How much money can I afford in a loan from the, that's guaranteed by the SBA? Does it make sense for me to locate it in an opportunity zone, et cetera? So I really commend them to you, and they're across the country and available to you, as I mentioned, at no cost. Next slide. I think I'm almost done. So here's where you can find them, like I said, across the country and at that website before. Next slide. Oh my gosh, we've come to the end. Okay, so I do want to commend to you the SBA. We are a resource for you. As I mentioned, if you are a small business owner, you have been adversely affected by the pandemic, please do reach out to us. You can apply for an economic injury disaster loan on our website at sba.gov/disaster. Now, keep in mind, please, that EIDL loans are not to resuscitate or resurrect a dying business or one that was dying before the pandemic. So you will have to share with SBA some of your financial information. The application itself is very simple and easy. So, if that's something that you need, please do reach out to us. We are doing loans for the EIDL at $150,000 maximum for the pandemic. The interest rate is 3.75% simple interest for up to 30 years. So even at $150,000, your loan payment would be around $500 a month. So it's designed to help you with your working capital. So it's long-term debt for short-term needs. And we do hope that you'll access us if you need it. Thankfully, here in South Florida, we have had not much of a hurricane season, thank God. But had there been one, you would have been also potentially eligible for physical damage disaster loan. And so if you're joining us from somewhere outside of South Florida and you've had a disaster in your area, no, not right now. Sorry, children. Gosh, they make you lose your train of thought. Disaster outside of South Florida, physical damage, yes, you can still access that loan for physical damage to your home or your business or your apartment if you're a renter at sba.gov/disaster, but don't click on the link for the pandemic, right? Not for COVID. So it's another part of the website. So thank you, Gray. Do we have any questions for me?
Let me double check. Oh, I do have one. Let's see.
Awesome.
Did she say that we can petition the governor to recognize a opportunity zone as a hub zone if it is not considered a hub zone already?
I did say that, but I think you also have to petition SBA, and I unfortunately don't actually know what that process is, but if you email me, I'll be glad to run it down. And I'm at althea.harris@sba.gov.
All right, there you go. And I
Awesome.
think, actually,
Another?
how do I get hub zone certification?
Okay, glad you asked. Go to our website, sba.gov/hub zone, and it'll take you there. But basically, you have to upload some documents showing where you're located. You have to be small. You have to meet all the eligibility requirements. But if you go to that website, sba.gov/hub zone, you'll get all the information you need for that.
All right, that is everything. Thanks so much for your time, as always. Appreciate it.
Thank you, Gray. Take care.
Thanks, Althea. All right, and with that, we are going to switch over to Peter England, the Executive Director of the South Dade Economic Development Council. Mr. England, are you on the line and unmuted?
I am Gray, and I am unmuted. Thank you very much for the opportunity to speak. For those of you who are not familiar with the Economic Development Council of South Miami-Dade, let's go to the next slide. The EDC was created back in 1992 in the aftermath of Hurricane Andrew, where there was frankly, a lack of leadership in South Miami-Dade County, particularly in the business community. And out of that, we began advocating and supporting business expansion, the creation of new jobs, improvements to transportation, local infrastructure. We represent here in South Miami-Dade the five municipalities: Pinecrest, Palmetto Bay, Cutler Bay, Homestead, Florida City, as well as unincorporated Miami-Dade County. Next slide, please. Our mission is to provide support and advocacy to existing and prospective businesses and promote initiatives which bolster the vibrancy and sustainability of the South Miami region. And next slide, please. We seek to improve and advance quality of life and expansion of business and job creation, implementation of projects that harness sustainability, resiliency through economic development, infrastructure improvements, education, and a skilled workforce. And I do want to make the point, we do not do this alone. We like to think of ourselves as the advocate for all of South Miami-Dade County and a great point of contact. If you wish to do business in South Miami-Dade County, we're the place to come. We can refer you and we'll link you up with whomever would be most suited to your needs. We work not only with the municipalities and Miami-Dade County, but also with the Beacon Council, the Greater Miami Convention and Visitors Bureau, Chamber South, the South Dade Chamber, and the South Florida Defense Alliance. So we cover a lot within our region, but we have a lot of friends with whom we collaborate. Next slide, please. This is our region, South Miami-Dade County. Our borders are defined by Kendall Drive on the north, and the Keys on the south, the ocean, and the Everglades. 600,000 residents reside in that area and 20,000 businesses. It is probably the most developable real estate remaining in dynamic Miami-Dade County, and by far the most affordable. Next slide, please. We like to think of this as the place where business meets nature. And we believe that this is the least urban environment that exists with all of Miami-Dade County. Next slide, please. But the subject for today is opportunity zones. And as you can see, we have a great many opportunity zones, as you can see outlined in the purple on this map. Most of them being along the US 1 corridor. And since we represent all of Miami-Dade County, if you were to ask, which is the best among these, which is the most prime for investment, do I have a favorite? That would be like asking me which one of my kids I love the most. I love them all, and my interest and my responsibility is all of my South Miami-Dade County, and we have tremendous opportunities for investment. Next slide, please. Why would you choose South Miami-Dade County? Well, there's any number of reasons. I've already given you the fact that we have the most developable and the most affordable real estate anywhere in all of Miami-Dade County. We also have an excellent transportation system, a world-class airport with the biggest international cargo hub in the United States. We have the Port of Miami handling containerized cargo and the cruise capital of the world. The Florida Turnpike runs right through the spine of South Miami-Dade County, providing great auto and truck access to the south end of Miami-Dade. And as far as local transportation is concerned, we're very grateful to the fact that there is a $300 million commitment on the part of the federal government, the state government, and Miami-Dade County to the bus rapid transit line, which will run from Dadeland South 22 miles to Florida City. That project has been approved, it's been funded, and the contractor for design and build has been selected. And we are right now on the verge of breaking ground. So this is pretty exciting news. And talking about excitement, next slide, please. We've got a lot right now to talk about, and these are just some of our more recent successes. Miami Wilds, as you see on the north end of this slide, is a water-themed park immediately adjacent to Zoo Miami. Then as you go down to the to the right-hand side in the middle, we have launched an application to host the command headquarters of the United States Space Force. And what's significant about that application is that it is not just an application for this site for Miami-Dade County. It is an application for all of South Florida. That is 4 counties, Palm Beach, Broward, Miami-Dade, and Monroe, have all collaborated to get behind this specific location. And I think from an investor perspective, this is really important news because it speaks to the fact that we have a great deal of regional collaboration that exists within this part of the world. And with that kind of collaborative effort, there's not a lot that can hold us back. So we are crossing our fingers and holding our breath and waiting for the selection to be made. And we're hopeful that we will be the location selected for the Spacecom. Amazon has very recently acquired the land from Miami-Dade County. They are building their largest facility in the state of Florida, again, immediately adjacent to Homestead Air Reserve Base. This is a 1 million square foot facility. It's a fulfillment facility. And if that weren't enough, they have now announced plans for 145,000 square foot warehouse facility immediately adjacent to Homestead Miami Speedway, which is very much in the same neighborhood. But of all the recent wins, I think the one about which we may be most proud is Atlantic Sapphire. And for those of you not familiar with Atlantic Sapphire, it's an eco-friendly, full-scale blue house salmon farm. Since America is the world's largest consumer of salmon, 90% of which is imported, this Norwegian company decided to search for an ideal location in the United States to expand in the US market. Atlantic Sapphire chose Homestead. The pure aquifer, free from man-made contamination, made it a perfect location, and 99% of the water used by Atlantic Sapphire is recycled, and all of the waste is used as fertilizer and a renewable energy source in the form of biogas. The fish are raised humanely and never have contact with sea lice or wild fish diseases. Atlantic Sapphire salmon is of high quality and has the least negative environmental impact. Approximately 5.5 million Atlantic Sapphire fish are currently swimming in their US and Denmark-based facilities. The company will be expanding its footprint across the United States, and their first US harvest was on September 28th of this year. By the end of 2020, they will have sold 3 million salmon here in the US. Next slide, please. So, if you've got an interest in participating in this dynamic environment, call me. I'm waiting for your call. We're open for business, and I want to thank you for your time. And Gray, thank you for allowing us to be on the program. If you have any questions, I'm here to try to answer them.
All right, thanks so much, Peter. There is one question that came in for you that's just wondering the geographic boundary for your EDC.
Right. On the north, it is North Kendall Drive, which is Southwest 88th Street. On the west, it would be the Miami-Dade Collier County line. On the east, of course, it's the ocean. We can't do business much beyond the shoreline. And on the south, it is the boundary between Miami-Dade and Monroe counties. Within that area, there are 600,000 residents and 20,000 businesses.
Wow. All right, that's incredible. Thanks so much. Thanks for joining us, Peter. And we'll let you know if any other questions come in. We'll send them your way.
Be my pleasure. Thank you.
All right, thanks, Peter. All right, with that, I think we are now back on track. In fact, a couple minutes early. But our next presentation is going to be from the village of Palmetto Bay. Maria, are you on and you ready to go?
I sure am. Good afternoon.
All right, good afternoon. Take it away.
All right, well, wonderful. Good afternoon, everyone. My name is Maria Pineda, and I am the Community and Economic Development Director for the village of Palmetto Bay. Quite a mouthful. Basically, we'd like to welcome you to our virtual Palmetto Bay presentation. Please, next slide, Gray. We are happy to be here. We're happy to present. We wanted to give you kind of a macro scale map so you know where we're located. Peter did a fantastic job. We work together. We collaborate often. We are kind of like one of those children that Peter mentioned. We are located south of downtown Miami. You can see downtown Miami up on the top portion, and then the next stop, basically going south, is downtown Dayland, which has been developed and is also part of that South Dade area. And then you see us in the green, which is our downtown Palmetto Bay. We are easily accessible. Our location is really a very interesting geographic location. We have major thoroughfares that run through our village. We have the beautiful Biscayne Bay access. We're in proximity to downtown Dayland and downtown Miami. And basically, we have an interesting geographic location. We have our downtown sector, which I'll show on the next slide, has a very interesting island piece that's divided by southbound and northbound US 1. Next slide, please. So at a glance, we're relatively young village. We incorporated in 2002, and we are composed of 24,000 plus residents. We're approximately 8 square miles. Our downtown district is approximately 25 square miles within that 8 square mile area. And our average home market value is approximately $466,000. Our median income is $104,000. And we are known, and we're very proud of our village, which includes many beautiful parks and amenities for our residents. Next slide, please. So let me tell you a little bit about our community. Our community is a very engaged community. Our residents are engaged, and they want to keep our community focusing on village scale type, but at the same time, they want to promote improvement, and they want new businesses, and they want to thrive. They want the businesses to thrive, and they want to be able to use those basic services. Our community is a very safe community. We have a very low, rate of police. I mean, actually, a high police enforcement. We are a very attractive environment, very social community. Financial stability is very solid here at the village. Our council and our residents are environmental stewardship promoters. They do want sustainability, and they are very conscious of that. And of course, there is always a lifelong learning process as we go and as we mature. The community is very focused on learning from experiences and trying to put those experiences into play for future. Next slide, please. So this is our opportunity zone area. As you see, the green indicates our track. We have a large area of opportunity zone within the village. It's approximately 80 square miles. We have done in our journey and discoveries, we have attempted to do a lot of the groundwork in order to be able to attract business in Palmetto Bay and attract investment in Palmetto Bay. We have conducted various studies and various kind of where we're at and what land we have available in order to be able to spur development. We have conducted an economic and market assessment in 2017. Obviously, this was pre-COVID, but this demonstrated a positive conditions in terms of economic and strength market opportunities for the village and its downtown core. The area that you see there highlighted in red, and it's bordered in red, is our downtown area, and that's known as a downtown district. And recently we have stepped up and revamped our downtown land development code in order to be able to entice the adequate village scale development that we are seeking, that everyone is seeking. And within this downtown area, we are also in the process of dissecting block by block and looking into every single land, possible land, to be able to develop and to be able to bring in new businesses to the area. Next slide, please. So to date, we have done some legwork already, and we have created some wonderful things here at the village. Our largest project is an infrastructure project. It's a $10.8 million Frangel Road project, and it is basically an improvement to our main street. This will be designated as our main street, and what we're trying to do is we're trying to entice a pedestrian-friendly downtown Main Street in order to be able to attract the right balance of vehicular and pedestrian. This particular project, as other projects within the village, have dealt with infrastructure improvements that are also trying to target sustainable principles within our village. We are also targeting beautifications along US 1, which is the major thoroughfare that you saw on the previous slides, which basically dissects or runs through our village, through our downtown, one of the perimeters of downtown. And we are beautifying that corridor, obviously, to make it better. We have our council is on board with residents, and council are very they listen to the council, listens to the residents, and they improve and make the necessary adjustments to be able to create a better village. We do have the commitment from leadership on capital improvement projects, which is great, which is only going to improve all of infrastructure. They are also aware of the need to spur new and to bring new businesses, local businesses, to our community. And something great that's also going to be able to assist in this process is the fact that we have invested in electronic plan review, which is, as you all know, it's a good thing for development to be able to pass through plans and be able to review plans and so forth. So that's to date what we have done and what we have invested that we feel is going to aid in bringing new businesses to the village and new development to the village. Next slide, please. Now, I'd like to just focus a little bit on the area that we have. It's a large area, as you can see, and This particular gift that we have been given, which is to be able to have such a large designation, hopefully will be able to be maximized, and hopefully it would attract investors to be able to realize that there's many things going on, many items that are coming in front of council that have been approved already that indicate and show potential development for this area. We have so far, what our intent is for the opportunity zone as an overview is to be able to create synergy and projects and to be able to create a nucleus for our downtown district. What we want to do is we want to create economic sustainable community that has a development that unites and creates a greater benefit for the entire community. We would like to focus on redevelopment, revamping of existing sites, as you can see on the bottom of the slide. That's the corner of Franja Road and 184th, which is basically our perimeter facing our sister city, Cutler Bay. And you know, we are trying to focus on different types of projects. We have outlined larger opportunities and opportunities that will combine different parcels together to make a cohesive and a larger impactful project. But we're also focusing on smaller areas and smaller parcels that can be revamped and can be redeveloped into a more useful and better use of the site, and of course the ultimate goal is to bring all these services to our community so they can be able to benefit from them. The enlarged area is a project that we had previously, which focused on a P3 opportunity, a private-public partnership opportunity that came about to our village, and the investor was interested in developing this through an opportunity zone fund. Unfortunately, we were not able to pull the trigger because at that moment we were reworking our land development code. But again, that doesn't mean that in the future, now that we have our land development code already adopted, we can't attract another possible investor to be able to invest in that area. Next slide, please. And I'd like to talk to you all a little bit about the projects and the wonderful things that we have in our village so far. Again, to reiterate, the entire downtown district area is within an opportunity zone. There's already movement and there's already spur in development, and we're already starting to see it. We have some projects that are already completed within our downtown district, and we have some future approved projects that are basically submitting. They're in the building permit phase, and hopefully we can see them going up pretty quickly. We would like to attract the right investors to come into downtown area and to be able to help us fulfill our vision, to be able to bring in business, and the intent is to be able to drive long-term capital in this area. Next slide, please. So we need to be able to have incentives, right? And we want to be able to bring them out so that you all can know of what kind of resources you have as you come to the village. Of course, as I mentioned, our community leadership welcomes investors. We have a very low millage rate, which helps overall. Our service staff, our staff is very service driven. It makes it very easy to do business in Palmetto Bay. We are, again, revitalizing our main street, and it's close to completion. So there will be a beautiful main street with all the bells and whistles pretty soon. We have a motion already started. We have a lot of development that has been piquing its interest and has been starting. Some projects that we have already approved are, for instance, the Audi dealership. Audi and Lamborghini are coming here. We're very excited to have them, and that's going to bring jobs to Palmetto Bay. We also have some local offices and medical offices are coming to Palmetto Bay to be able to provide services to the residents. We want to be able to let you all know that, again, the projects that we are looking into are projects that we feel are definitely going to be impactful to our community, and that's the #1 goal of council, leadership, and staff. We offer the ability to have a very simple land development code that's very straightforward, very clear, and very concise, which is it's good for for as far as design process is concerned. And we like to think outside the box approach. We like to work with you all to see if there's anything that interests you that we can both benefit, the village and yourselves. Next slide, please. And just to kind of finalize what our goals are and how we want to use our opportunity zones and maximize our opportunity zones. We would like to promote mixed-use properties and development, support entrepreneurship and business owners. We want to retain and we want to improve the businesses that we currently have here. We want to support any new growing businesses by creating new hubs. We've started doing that already. There has been interest to be able to start off business hubs along the village. We have a perfect example, which is a mobile barbecue place that started on the eastern side of the village, and they have been very, very successful. The residents are very happy with the setup they have, and it's provided something that Palmetto Bay didn't have before. So we have welcomed that business. We welcome all startups. We want to make sure that we are a place where it is easy to start a business. We want to be an incubator space for entrepreneurship and entrepreneurs. We definitely want to always do the right thing when it comes to sustainability, and we have a land that we are able to redevelop, brownfield land. And the intent is definitely to bring in the money to Palmetto Bay and keep it here and produce, produce these businesses and keep and promote local businesses. Next slide, please. And with that, Gray, I will ask if you can please click into the black box. It is a video that we prepared to kind of just give you an overview of the village.
Oh, sorry, Maria. This is saved as a PDF, so I don't think it's gonna work.
Oh, what a shame. Okay, well,
sorry about that. I didn't know you had a video you wanted to show. Would have been happy to do that, but we will make sure that if you provide me a link, we'll make sure that we have the SBDC send that out to everybody that registered.
Absolutely, no problem. And with that, I thank you, and I look forward to any future synergies. If you need to contact me, my email, and I apologize, I did not put it on the slide, but my email is mpineda@palmettobay-fl.gov. And with that, thank you so much. Have a good afternoon.
All right, thank you so much, Maria. Thanks for being here. All right, and with that, we are on to our last presentation of the day. Mr. George Garrett, are you on the call and unmuted?
I am. Good
Hey, there you
afternoon.
are. I can hear you loud and clear. Take it away.
Super. Last but not least, I promise, we're a little different than I think, first of all, obviously our discussion is not technical. We've seen that. And we're a different community than South Dade. If I can, I guess I'll introduce myself first. I've been in the Keys about 35 years now. I came actually as a biologist. I'm now the director of planning for the city of Marathon. I've been the director of marine resources for the county. And so I've had a pretty wide history here. It's very interesting. As I sit here in the city of Marathon, which incorporated 1999, much like our previous speaker, we're in a growth phase. Having said that, it's also an old community, which is really seeing a tremendous amount of regrowth or redevelopment, largely because land is limited. we're an area of, and some of the oldest development here, I guess, really doesn't go back that far, but to the 50s and 60s, earlier as well. But that's really when its major growth spurt was and occurred. There was a significant amount of platting and of subdivisions, residential subdivisions, principally in the 60s, 70s, and early 80s. And maybe at this point, I'd say advance a slide and let's at least get a look at the area for everybody. So kind of the center here is, well, most of this is Marathon with Long Key on the right-hand side as you guys see it. And we are the center of the Keys, roughly mile marker 50 from Key West. Key Largo is about 106th as you're turning up to head up into that South Dade area we've been talking about. We're a population of about 8,200 people. The area of the island is approximately 5,200 acres on a stretch of about 15 miles of highway. So that tells you how long and narrow we are. And if you're to put it into square miles, it's about 8.2 square miles, which is not a huge area. So as we began to look at the possibility of being an opportunity zone, and that came to me in a meeting one day when, we need to create an opportunity zone. Where do we want them? I think what I've got outlined here were our proposed zones. They're obviously our census tracts, as you can see the census tract numbers. Ultimately, what happened is the governor's office selected 9711, which is kind of the center of the city. You can see the kind of white line down the middle, which happens to be the Marathon Airport. Probably, honestly, not the best zone for the city. The redevelopment potential, I think, was largely in the west end of the city. It's also a part of the city where the core of Marathon is really US 1, and that west end actually has streets that parallel US 1 and had a broader potential, I think, in some of the older development for redevelopment. But we are a place of significant redevelopment lately. Again, a small community which has redeveloped almost 700 hotel rooms. We've added almost doubled our affordable housing. And are looking at, particularly from Hurricane Irma, the replacement of almost 500 homes, which may not have been completely destroyed, but were substantially damaged enough that people have either individually and personally reinvested to elevate their homes and make them both code compliant and FEMA compliant, or simply they've been bought and somebody else has done that. Advance a slide, I guess. So here's the core of our opportunity zone. Again, it probably is not the best possible zone, but I think I would argue that the city of Marathon is really a great place to live and invest. Obviously, we're surrounded entirely by water. Our principal industry, frankly, is the tourist industry, which goes along with the hotel redevelopment we've seen. We still have a very vibrant commercial fishing industry. For any of you who have been to Marathon and gone to I just blanked, but the seafood at Keys Fisheries on about 33rd Street, which is outside of this zone, you'll know that place is also being owned by Joe Stone Crab. So a good number of your stone crab are coming from fisheries within the Keys. I think advance one more slide. I sort of outlined what I think the potential is here. And again, it's largely along the corridor of US 1. There may have been some better opportunities to the west, but things are happening. The kind of linear strip along US 1 that you see there highlighted in blue is really our commercial core, which lies along the US 1 corridor. And then there's a couple of vertical areas that I've shown that I think actually for the Keys 8 or 9, 10 acres is a big area. The one to the west side or the left side of the screen is about 9 acres and probably has the potential for about 50 homes if that is possible. The vertical bar you see on the right, kind of south side of the water, is actually, and I'll show that a little bit further in a few minutes, that's actually a project that is underway to redevelop an entire street, in fact, that runs from US 1 to the water. All residential homes being purchased and put together by a small set of buyers. And virtually all of the homes on that street were significantly, or in fact entirely, devastated by Irma. So it was a great opportunity for them to bring those things up to code. And then kind of the loop I've got, or the circle I've got up above the airport and to the west, or the east side, sorry, is an area that's kind of industrial area within Marathon and serves as another possibility for investment. You know, what brings us, I think, interestingly to why this area in particular could become an opportunity zone, I think, is really the very strange mix of economics we have here. It's a place where a significant number of the homes now are vacation rentals. In a population of 8,200 with approximately 2 to 2.5 people per household, you can kind of do the math. We have approaching 700, 750 vacation rentals. So that tells you a little bit about what the dynamic of our population is right now. I lost my train of thought. Sorry, Althea. I think you did. In any event, it's a place that is largely tourist driven, residentially driven, commercial along US 1, so on. And there is a significant amount of redevelopment going on. Great place to live. But it is a place also that from an income perspective is very different than many places. If you look at the population, it's an ALICE limited population. For those of you that know what ALICE is, asset limited, income constrained, and employed. So many of our folks are living at limits of income, which again make this a great place for an opportunity zone potentially. And the flip side of that is that airport has jets landing on it continuously. I happen to look out the window frequently and see those folks landing all the time. So there's also some very wealthy people here. And what ends up happening, I think, is if you were to sit there and plot that dynamic of population, you'd see a lot of people on the left-hand side of the curve and a lot of people on the right-hand side of the curve, and not so many in the middle in the typical view of a bell-shaped curve or something like that, which I think really leads to the issue at hand. But other than that, it is a great place to live. It is a great place to work. For those people who do work here, we have consistently maintained a great, even through the 2008, 9, 10, 11 timeframe, you know, a working population that, while the rest of the state of Florida was in a little bit of a hurt, I think the worst we got is maybe unemployment of maybe 4%, 5%. So with that, I think I'll finish up with you. I think there might be one more slide, but yeah, it's just, I think I went through most of this already, but, and one more. So, and here is actually the area that is subject to redevelopment right now. A series of about 5, well, actually, I think it's about 8 or 9 homes with some vacant property associated with it, which I think those folks are going to redevelop, probably demolish all of that and redevelop with about 10 homes, and most of which I think will be vacation rentals. So with that, I'll close. I think we're good.
Thanks so much, George. Thanks for joining us and giving us that overview of Marathon. Always great, whether you're investing, coming to visit, anything. I love being down in your part of Florida.
It's an interesting dynamic, and it's very different than there. So I've lived here 35 years and love doing it. So please visit.
That's great. All right. Well, y'all, if anyone has any questions for George, I don't see any in the questions box right now, but y'all feel free to send them my way. You have my contact info. I'm happy to get you in touch if you want to talk directly with him. All right. Well, thanks, everyone. That's going to conclude our webinar for today. Thank you for joining us on behalf of Madison Street and on behalf of the SBDC at FIU. We are glad you joined. If you have any questions, send them my way. Even for any of the speakers, I'm happy to get you in touch. As I mentioned earlier in the webinar, this has been recorded. The handouts are available. All of these slides that we've gone through today are available. You can download those right now while the webinar is still live under the handout section. Otherwise, the SBDC at FIU will be following up with all of our all the folks that registered. Sometime in the next couple of days, they'll follow up and send out a link to the slides and a link to the recording. So thanks, everyone, and have a great day.